All right, yo, what's up, everybody? Let me get this started here. Yo, what's up, everyone on the replay? Hope you're having a great day. We just had some really great earnings from NVIDIA when you exclude a one time adjustment. And today we're seeing a huge software rally. If only someone would have said that Q3, Q4 is most likely going to be the software bottom. I've been saying all these software stocks, the valuations were dog cheap. Some of them I'm still skeptical of. Like, I don't think I'd buy Adobe, even though they've had such a nice recovery. But there's certain software plays that are just doing great. Salesforce is up 21%, Innodata. And let me see if I can find NVIDIA. Oh, yeah, RIP Wendy's stock. Wendy's is down 13% on the day. Did you know Wendy's is below their 1997 IPO price? But we're seeing a huge rally in cybersecurity today. CrowdStrike and Palo Alto Networks, I've been a believer that hackers will utilize AI and get better at hacking, and then more AI usage will come as we need to defend these attacks. Just like CrowdStrike, Palo Alto Networks, they've been doing great. But I want to give you a quick stock portfolio update. Then I have a few stocks I want to share with you myself that I promise will impress you. Like, I actually just made a TikTok 10 minutes ago talking about BUKS stock. Check this out in the top right. This whole company, this is a hidden gem micro cap I want to introduce to y'all. This whole company is worth $266 million. You know, a really small company. There's a ton of stocks out there worth $260 million. I want to own the one that literally made 6 million in net income this quarter, up 98% year over year. They're the most profitable they've ever been. Whenever you make $6 million and your whole company's worth 240 million, that's a couple percent of the whole entire market cap. And what does this company do? They make aerospace and defense products, electronics. I'll show with you their website right here. They're focused on aerospace engineering, aircraft modifications and electronics, and professional management service. So it just seems like a pretty cool micro cap. Again, out of all the companies worth 260 mil, I want to own the one that's actually making a decent amount of net income every quarter. So let me do a quick portfolio update, and then I'll dig into some of these other stocks that I think will impress you. So first, I'll start here. And what's up, Vega, Roland, Moda, Louise? Good to see everyone. Hope you're having a great Thursday. So this is my Mumu portfolio. I call it my buy and never sell account because once I buy a stock in here, I literally never sell it. I just diamond hand it for the long run. And open profit and loss, we're now up $27,000 all time. Not too shabby. And mainly it's because of our strategy where I'm not selling anything. And I've been tempted sometimes, like Powell Industries, we're up 600%. Comfort Systems, we're up 300%. In the past, I've been tempted to at least trim a little bit, but I'm not allowed to. And I'm actually glad I've never sold any shares before today because that would have been the wrong move because all these stocks have been going up much higher. So that's kind of one strategy I recommend. Whenever you're in great growth stocks, don't trim or sell them, even if you're up a bunch, if the valuation still makes sense. There's a saying like, don't trim your flowers and then go plant weeds. You know, don't trim your winners and then go buy some lesser quality stock, in my opinion. But maybe I've always been a fan of you can upgrade a position. If you have a stock that, you know, your thesis kind of changed, the financials got worse, you can upgrade that by selling it and buying a new position. So anyway, that's that portfolio. Next up is my Webull account, where open profit and loss were up 34% or $5,100. Whoops. And these are all the stocks that we own in here, and I'll sort by largest companies. So my largest holding is Futu, then AMD, Microsoft. No way. We're now up 40% on Microsoft. It literally feels like a week ago when we bought Microsoft. We literally didn't buy them that long ago. That's one stock I've been shilling. I've been saying this is one of the best. Like, actually, it's the best software stock to buy on the dip. Yeah, that was ticker symbol BUKS, that stock I was talking about a minute ago. Yes, sir. What's up, Victor? And then I got Dave, the fintech stock. Moeller Industries is one of my newest positions. My very newest position, actually, it's not Citigroup. Here, I'll sort it by newest positions. My very most recent purchase ever, I bought them legit days ago. There's my buy order, you know, 3 candlestick days ago. MYRG stock. This stock's fascinating. A 25 forward PE. Very cool company. Then I bought Citigroup. This is another one that I think is pretty interesting. And I'm not scared to buy stocks after a rally. You know, some people might call me crazy. I bought a stock after this huge rally, but Citigroup still seems fair to me. And I don't think this is some peak valuation. Citigroup has a 2%, over a 2% dividend yield. They're at an 11.8 forward PE or 11 times next year's net income. They just announced they're going to buy back over actually 15% of all the shares that exist, a new share buyback program, after they've already bought back over 6% of all the shares this past year. they're a very shareholder-friendly company, 2% dividend, share buybacks, and then I got Reddit, Clear Secure, SoFi, AbbVie, a healthcare name, Uber. I really like Uber as a software name, although there's some robo-taxi, Waymo fears. I think Uber as the platform where you go to book a robo-taxi, that's where they're going to make a lot of money. We got Ouster as a small position. It's a LiDAR company selling the LiDAR kits to the robo-taxis, and they have their very first native colored LiDAR, as well as selling this to counter drone defense companies. So they're used in drone defense. But yeah, that's this portfolio. Oh, and another one of my newest purchases is AppLovin. I just bought one more share at 303 a share. There's my little buy, that little B at the bottom. That's my little buy order right there. I like how it kind of displays it. So yeah, that's my Webull portfolio. I know I got way too many stocks here. Last portfolio, then we'll check out some of y'all stocks right here. This is my dividend only portfolio. That's been my worst performing portfolio the past year. Since 1 year ago exactly, we are only up 2%. And year to date, since January 1st, we're down 1.3%. And here are all the stocks that we own in here. And this is my lifetime percent gain on every stock. So the only company we're down on is McDonald's. A lot of these QSR, quick service restaurants, are struggling. Like Wendy's is below their 1997 IPO. Red Robin's below their 2000 price. Same with Krispy Kreme. Same with Cracker Barrel. Same with Jack in the Box below their 1999 price. It's really sad. But out of all the QSR restaurants, McDonald's is the best positioned as a real estate royalty play. And yeah, we got Constellation Energy, Meta, Google's been great, one of my favorite buy and never sell stocks. And finally, last portfolio, my Roth IRA. A Roth IRA is just a tax-free retirement account. It's so OP. It's so OP that the government literally only lets you deposit $7,400 a year. They don't let you invest anymore. And if you make over a certain amount of income, salary, they literally don't allow you to invest in your Roth IRA. So I'm a big fan of the Roth IRA tax-free retirement account. You can even use the money before you're 55 if you're a first-time house buyer, you can actually use it as a down payment. So I'm actually probably going to do that, which is pretty cool. So yeah, these are the 4 stocks I own in here. Pretty simple. HCA we're down on, CareTrust we're down on. But yeah, that's all my portfolios. Let's see what all of y'all have to say. What's up, Orlando? Good afternoon. Good afternoon, Vega and Louise. So someone says CORZ stock. And hopefully I didn't just unplug my mic. There's a chance I just did. Okay, good. CORZ stock. I cannot find this company right here. What the heck? Okay, CORZ. Or maybe it's just my Wi-Fi being bad. Oh, Core Scientific. Yeah, this is that Bitcoin mining company. So I don't really love this industry, but what does this company do? They own a bunch of graphics cards. Like they literally own a boatload of NVIDIA chips. And what do they do with those NVIDIA chips? Well, they now rent it out to cloud companies. So yeah, actually, if you look like 2 years ago, 100% of the revenue was digital self-mining. So they were mining crypto, mining Bitcoin. But now they're actually renting out their GPUs to cloud companies. The only unfortunate part is it's not really a profitable business. Looks like they're really leveraged too, a lot more liabilities than assets. They lost $1 billion in net income this quarter. So look at how the liabilities went up. It went from 4.3 to 7.7 billion of liabilities. That's what happens when you lose net income. That money has to come from somewhere. Super negative free cash flow. So I honestly wish I could, well, actually look at the forecast. The forecasts aren't too bad actually. Whoa. They're only going to lose 4 mil next quarter, only going to lose 2 mil the quarter after. So actually, that's not too bad, actually. They're barely going to lose any money, but it is still hard to value this one. You know, a 383 forward PE. At least they do have a forward PE, and they lose a bunch of free cash flow. But I would just be cautious of the industry that they're in. You know, they're competing with CoreWeave and Nebius and Meta. So it's a GPU rental company now. I actually do like how they shifted the business. So, Kevin says SoFi stock. Yeah, hey, I'm reading both the YouTube and the TikTok chat. What's up for everyone on both streams? And then we'll check out Buck's not on Robinhood. Oh, yeah, you know, it might not be. But what's up, AJ? And then we'll look at NVIDIA. Oh, yeah, NVIDIA just reported earnings. We'll definitely do a small little deep dive into them. They were really good when you exclude the one-time Anthropic adjustment. So next up is SoFi. I do own this one. I am up a pretty good chunk. I always regret trimming my SoFi position, but I got 27 shares of SoFi left. This company impresses me. It's a pure growth stock right here. If we just zoom out on their revenue right here, Check this out. This is what you want to see for a growth stock that doesn't really pay a dividend. Just every quarter, the revenue hits a new record. And not just the revenue, we want to see a growing top line and also a growing bottom line. And they grew their net income 61% year over year. They're actually a money printer. And check this out specifically. So this was peak net income, 173 million net income. Well, look at these forecasts. This is why I'm extremely bullish, more bullish than most people. They're going to make 230 million in net income next quarter and 258 million in net income the quarter after. I mean, that's insane, the net income. And check out the revenue expectations. Revenue is growing from 1 to 1.32 billion. They do loans, lending. That's 50% of their business. Their main business grew 63% year over year. Incredible growth. And then the other half of the business, this financial services, this is growing very fast too. It's up 29% year over year, but that's after it grew 105. And that's after that grew 80. After that grew 222. I mean, SoFi's on this streak of growth. And here's the coolest part. Here's why I like SoFi. The forward PE, which is really how you want to value SoFi for a company growing their EPS very fast in just 2 quarters, they only trade at a 24 forward PE, which is literally cheaper than the S&P 500. They only trade at 24 times next year's net income. Even Morningstar says they're modestly undervalued. Accelerating net interest income driven by balance sheet, Gee, I don't even know, did they even cover this one? They do. See, that's pretty cool. So anyway, SoFi's great. I honestly wouldn't mind nibbling right here. I actually was just buying. Actually, even though I'm up 173%, if you look at the top, I just bought 2 more shares at $15.26, $15.65, and that was right around before earnings, and now they're $19. I wouldn't go crazy buying them yet, but certainly one I wouldn't mind maybe nibbling on if you like their financials. Of course, always go do your own research today. But yeah, the elephant in the room, let's talk about NVIDIA real quickly. I'll give you a quick overview of the earnings. They're up almost 10% on the day. And if you've came in my past streams, the past like months and weeks, I've been saying for the longest time, NVIDIA is still undervalued. A lot of people see this chart right there and they're like, okay, the rally's most likely done. And excluding today's gain, here's the thing. This isn't some peak bubble valuation. Did you know NVIDIA only trades at a 19 forward PE or 19 times next year's net income? It's ridiculous. That's super cheaper than the S&P 500. That doesn't seem like some peak bubble valuation to me, but here were their earnings versus what the analyst forecasted. The orange line is what analysts projected at 92 billion. They did 96 billion. And on net income, they expected 51. They did 59. And it was a quadruple beat. They beat on EBITDA, so there wasn't some accounting fluke. They really did beat on every single metric. And check out the margins. This is the craziest part. This is like the purest AI picks and shovels play selling the GPUs. They're rocking 60 to 70% net margins every quarter. And notice the past 5 quarters in a row how the margins are growing and expanding. For every $100 that comes in, NVIDIA is keeping like $65 after tax. Revenue's 96 billion, up 105% year over year, and they kept 59 billion on that after tax. And that's real. Before tax was 63.7 bill, after tax was 59 bill, up 125%. Monster balance sheet. You get a 0.5% dividend with NVIDIA. It does, psychologically look like a tough buy because it's at an all-time high, and I would probably wait for a little sell-off, but I can't be bearish when NVIDIA is at a 19 forward PE or 19 times next year's net income. Even Morningstar saying they're still undervalued. Relentless demand for its industry-leading AI infrastructure and high customer switching costs driven by proprietary CUDA software platform will continue to propel long-term value growth. So hopefully that was kind of some helpful analysis on NVIDIA there. Pretty cool. So someone says, can you see Google? What is happening with the stock? So yeah, Google's been down a little after they've been issuing debt. So they kind of diluted shareholders by $60 billion to fund CapEx. They did a $20 billion bond issuance. And I am not worried in the slightest. This is another huge weighting of the S&P 500 that we've all heard of before. Google, YouTube, Android, Google Cloud. We've all probably heard of their products before. Again, this isn't some bubble valuation to me. 24x forward PE, 24 times next year's net income. That's actually cheaper. The S&P trades at a 26.4. So they're actually cheaper than the S&P 500 right now. That's why like the biggest weightings of the S&P 500 still aren't like at peak bubble valuations. Like there's still a lot of room for the S&P 500 to grow. So the thing about Google is actually, let's see if there's any news. There's always a bunch of news. Google launches Gemini 3.5, Alphabet's Waymo to launch robotaxi service. Okay, Google secures a 12 billion warrant. Oh yeah, Marvell is now making some of Google's TPUs. Yeah, Google raises some money. So anyway, here's the cool part about Google. These forecasts are just ridiculously good. They had a one-time adjustment. It says they made 112 billion net income. That was a gain from their SpaceX investment, a realized valuation, but the revenue grew 24, excluding the one-time adjustment, the net income grew by 30. And if we zoom out, this is the operating profit that excludes that one-time accounting fluke to their net income, because it says they made 112 billion after tax. That's not true when the before tax number is 40 billion. This is their most profitable quarter ever by far. That's what you want to see. 25x forward PE with some of the most quality assets. They have a monopoly on search. They have a monopoly on YouTube. They own Android. And check this out. Google's growthiest business lately has been the Google Cloud. Did you know it has a $520 billion backlog? And the Google Cloud revenue grew 81% year over year. That is the fastest growth rate on the entire screen. I mean, there's so much more I could say about Google, but I don't want to, spend too much time on one stock. But again, I think the valuation's very fair. So Roland said DFNS stock. And again, I'm seeing a lot of great suggestions here. I really apologize if I'm missing some of these. I do want to get to Marvell as well. That one's, yeah, they're now making TPUs for Google. They already make TPUs for Amazon. They supply NVIDIA with fiber optics. They are pretty cool. So someone says DFNS. Actually, we're not going to really cover this company right here. I don't really like to cover these. This is a micro cap at an all-time low. Like if you look in the top right, this whole company is only worth 21 million. It's just hard to trust these kind of companies. What's the short interest? Let's check that out. So yeah, literally 14% of all the shares are being shorted. So there must be some bear case here. Let's see the net income. So yeah. So here's the thing. You could buy the whole company for $21 million. Let's say you buy them for $21 million. Where you're buying a company that lost, well, this was a one-time adjustment, that lost $26 million last quarter, $10 million the quarter before, $16 million the quarter before. So, and revenue's really low. So honestly, nothing's really blowing me away here to want to buy this one. Do they have, yeah, look, they're going to lose. They've been missing on expectations, but they're going to lose 3 mil next quarter, 3 mil the quarter after. And again, when your whole company is only worth 21 million, losing $3 million is more than 10% of the entire company. So no wonder the stock's at an all-time low and 15% of all the shares are being shorted. I can understand the bear case there. So what platform is this? Hey, I'm actually on a brokerage right here. It's where you buy stocks like Schwab. It's actually linked in bio if you'd like to check it out there. Broker called Moomoo, my favorite app to buy stocks. But here's Marvell Technology. So yeah, they just entered an agreement with Google to produce their TPUs. Let's see. Yeah, multiple analysts raised price targets and maintain buy ratings on Marvell following the Google custom chip deal. Marvell Technology and Google expand custom AI chip partnership with 12 billion agreement and 120 billion revenue potential for Marvell. Pretty nuts, so I can see why this stock has done so well. And with this new Google deal that literally came out just like a few days ago, I believe these forecasts are going to get revised higher. Check this out on the left. The revenue is 2.07 billion. The forecast on the right for the 1 year after is going to be $3 billion. And I think that's going to get revised higher. Look at the net income slash EBITDA. It's growing from 750 to 1.14 billion. So net income's doubling in just a year. So you really want to value this stock using a forward PE ratio. And when we do that, they are quite expensive. They trade at 97 times next year's net income, but the boat. But here's what Morningstar says. Morningstar actually says they're still undervalued. A strong position in optical chips, accelerating custom AI silicon deals with major hyperscalers like Google and Amazon, and an expanding data center networking portfolio will drive long-term value growth. So pretty cool company here. Just the valuation's a little too high for me to pay right now. But this new Google TPU deal where they're manufacturing Google's chips are great. What happens is, yeah, hey, again, this is a brokerage. It's linked in bio there if you'd like to check it out. Show your portfolio. Well, I actually have multiple portfolios and multiple brokerages. The one I've been talking about, I use this brokerage because it's honestly the best one. I have all these linked, but the one linked in bio is this one. I have an affiliate link for all these, but this is the best one in my opinion. Literally costs nothing, completely free, lower fees than Webull. But yeah, here's all my portfolios. I got a few different portfolios here. I have a Webull account, open profit and loss. We're up 34% all time. We also have a Robinhood portfolio. I call this my dividend only portfolio in the top left because every stock in here must pay a dividend, but most of these are like dividend growth stocks. But let's get back to the analysis here that you guys I kind of do the whole entire stock portfolio updates at the beginning and end of every stream. And I do a ton of portfolio updates on my YouTube channel. So I actually just made a video 2 days ago, new stocks I'm buying. So if you want to help a brother out, check out my YouTube channel. Just type into YouTube Nathan Robert, you'll find it. And I'm streaming there as well, so you can watch it and rewind it too. I know I sometimes talk too fast. Someone just said that. Yeah, I know. I have talking way too fast. I'm thinking of an equity position in AppLovin if it holds. What's up, Dr. Lewis? So that is one of my most recent stock purchases that I am down on. I almost promise this stock will impress you. If it doesn't, feel free to leave and hit the dislike button. This is crazy right here. This is AppLovin. And there's my buy order. I literally just bought more of this stock. A little B right there that it shows the buy orders, which is pretty cool. I just bought one more share of AppLovin, and this stock genuinely has the DNA of a multi-bagger. So there's a ton of stocks that are on like a huge downtrend. Like this one's on a 40% down from its peak. There's a ton of stocks 40% off their peak. Out of all the companies 40% off the peak, I want to own the one with these sort of financials. Check out the revenue this quarter. Up 52% after it grew 77%. The revenue is 1.9 billion. This is the most impressive part. This is why I'm buying this one. On this 1.92 billion revenue, they kept 1.27 billion in after-tax net income. And that's real. That's not some accounting fluke. Before tax was 1.49, after tax was 1.27. They genuinely rock 65% net margins. So for every $100 that comes in, they're keeping $65 after tax. They're printing like $1 billion of free cash flow a quarter, over $1 billion in net income a quarter. And if we just zoom out right here, this is what you want to see for a growth stock. This stock is lower than it was 2 years ago, yet the net income is the best it's ever been. So there's a disconnect between the financials and the stock price, and that's my favorite time to buy a stock. And the forecasts are great. So this was a record net income, 1.27 billion. And the next quarter, they're going to do 1.36 billion and 1.54 billion the quarter after. And you probably are guessing this stock would be expensive. They're not. They're cheaper than the market. They traded a 17 forward PE or 17 times next year's net income. Even Morningstar saying this company is undervalued. Their powerful AI-driven advertising optimizer and their successful expansion beyond gaming into e-commerce and connected TV will drive long-term value growth. If you don't know what AppLovin does, if you ever see a mobile ad on your phone, it's almost certainly through AppLovin. They have a monopoly on it, and they're expanding their advertising now to e-commerce and connected TV. So I'm a big fan of AppLovin. Is there any news? Nope, no news on AppLovin. But again, I just bought this one. I think the risk reward just looks fair. So hopefully that was helpful there. So Anthony, what's up, man? Sorry I missed your stock there. I saw that one at the beginning of the stream. Again, apologize if I'm missing out on some stocks here. What's up, Moda? Build-A-Bear and Wendy's are down. Yeah, those are my biggest losers on my on all the stocks I kind of watch. Check this out right here. Oh yeah, software is having a great day. Okta, Salesforce, CrowdStrike, Palo Alto Networks. But what are the big losers? Build-A-Bear Workshop, Wendy's. I feel bad for Wendy's. They're lower than their 1995 IPO. So they're practically a charity. Sphere Entertainment. This is the company. If you ever heard of the Las Vegas Sphere, those like spheres, like LED screen, they own those. Anyway, let's get back to the analysis here. Lithium America. So are they making revenue yet? I don't think so. This might be one of the companies. I believe the U.S. government just literally took a 10% stake in this company. MP Materials as well got a 10% stake from the government. The government is trying to invest in American and Canadian rare earth metal providers because China's being annoying. They're making us have certain permits and export licenses to now buy certain rare earth metals from them. But yeah, dang, here's the part that where I don't know about this one yet. If we look at their revenue right here, this is still, a revenue-less company, and they're not forecasted to make any revenue anytime soon. So, it's how do I value this stock? There is no revenue anytime soon, and the free cash flows, dang, they're losing 300 mil, 200 to 300 mil of free cash flow a quarter. They're losing 10 to 20 mil of net income a quarter. So that's one thing I would be a little concerned about. That's why I would be cautious. So I love giving you my honest thoughts. I never give companies the benefit of the doubt. Yeah, here's that Wendy's thing I was talking about. Here's Wendy's monthly stock price. Wendy's in 1997, their IPO was $13 a share. Wendy's is $7 a share today. All these QSR restaurants are having a very tough time, and I feel bad for them. Like it's not just Wendy's, even Jack in the Box, they're lower than their 2001 stock price. I won't go through all these, but like same with Red Robin, Krispy Kreme. Yeah, unfortunately. But out of all the QSR restaurants, again, my favorite purchase is McDonald's because they're really a real estate and royalty company. They're a franchise model where they own the land under all the franchises, so they're a huge real estate play, and they collect royalties. So 80% of every McDonald's you see is a franchise. The corporation doesn't own it, and all those franchises, for every $100 that comes in, they pay a 4 to 5% royalty back to the parent company as a sales and marketing royalty. They have one of the biggest reserves in the world developing a mine. Hey, thanks for that good context there. He was talking about Lithium America, so they have a lithium mine under development. So I wonder, like, let's see. Yeah, check this out. Thacker Pass Lithium Project is progressing well. Um, Targeting mechanical completion in late 2027. So there you go. Yeah, and they got a DOE loan as well. So what's the bear case on AppLovin? I think AppLovin max could fall another 10 to 15%, and that's it. Like I genuinely wouldn't believe they're going to fall much more, or for APP stock. Someone says Nokia stock. Let's do Nokia. That's an NVIDIA holding. So if we go to NVIDIA's portfolio right here, you didn't know they own a bunch of Intel. They own SpaceX stock because they're buying their chips. They own CoreWeave because they're buying their chips. And they also own, a smaller position, Nokia stock. So the main growth driver behind them has actually been their AI cloud and I think optical business right here. Oh yeah, Nokia closes their like Chinese R&D center, cut 1,600 jobs in a near full China exit as their AI business surges. I wonder if we can find that. Nokia's AI and cloud business posted 105% growth in Q2. With new orders of $2.8 billion, Nokia is collaborating with NVIDIA on an AI RAN platform and raised its full year guidance. So pretty cool. This is a European company, so we'll convert the currency from euros to US dollars. I wonder if we can find optical and IP networks, Rose. Here's the thing, though. Their core business, like when we think of Nokia, we think of those, phones. If we zoom out on the monthly chart here, like Nokia is, in the year 2000, this was a $55 stock and it's a $10 stock today. They've completely shifted the business model away from kind of smartphones, but still half the revenue, even this quarter, is still that mobile infrastructure. But the growth driver has recently been that AI business. But Morningstar actually isn't so bullish, and the 32 forward PE is decent. Morningstar says they're a bit overvalued. While optical networking demand from the AI data centers provides some nice growth pockets, there's intense competition in mobile infrastructure, the commoditization threat of open RAN technology, and ongoing supply constraints require caution. But check out the left. The PE on the left, it's a 70, so they trade at 70 times net income. Look at the forward PE. They only trade at 32 times next year's net income. It's getting cut by more than half. That's because their net income is doubling this next year. I have noticed, though, they have missed on net income the past, 3 quarters in a row. But if they can meet these expectations, hit 275 mil next quarter, 914 mil the quarter after, they really do only trade at 32 times next year's net income. So revenue. So there is a bit of kind of mid-single digit growth, like 5% revenue growth this quarter. The net income actually net income technically went negative this quarter. I wonder if that was that restructuring charge, but they're decent. I would be a little cautious. Check out Micron. Thoughts on Rolls-Royce? Hey, what's up, Luke? You know what? Let's do Rolls-Royce, then we can do Micron. What's up, Charlie? INFQ. We'll check that one out too. I'm not smart, but I would not touch Wendy's or Build-A-Bear. Yeah, me neither. The growth story on those two are in a struggle right now. What app is this? Yeah, hey, again, this is a brokerage, just like Schwab, E-Trade. If you'd like to get it, it's linked in bio there, a brokerage called Moomoo. My favorite brokerage. I have a ton of brokerages too. There's no burden of having multiple brokerages. Like I have a brokerage with Webull. I have a brokerage with Robinhood. It's just an extra filled out sheet of paper that you just mail over at the end of the year to the IRS. So yeah, it's completely free, costs nothing. It's literally, if I was looking for a brokerage to start today, I would not get Webull or Robinhood. I'd get Moomoo. It's the best one. I wish Anyway, I've been using all these for years. Linked in bio if you'd like to get it. It is an affiliate link too, full disclosure, but you can just type it into Google if you want Moomoo. But if you sign up with my link and deposit $100, we'll both get like a free fractional stock or something like that. But anyway, let's do Rolls Royce. I think it's RR. RYCEY actually. This is another European aerospace and defense company. And if you didn't know, all the aerospace and defense stocks are doing phenomenal because of all the geopolitical war conflict. But a lot of people, when they hear Rolls Royce, they think of the cars. This company, I think they've like spun that business off. This company literally just sells, aerospace jet engines. Like civil aerospace is half of their revenue. Power systems is 23%. Defense is 22.5% of the revenue. So it really is like a pure aerospace and defense play. And they have really improved their net income. I mean, check this out. If we zoom out, the net income was amazing. And they're a European company, or actually, I think a UK company. Yeah. So they actually report their currency in British pounds, but that's why they report in first half and full year. They don't report quarterly earnings, but they, for full year 2025, net income was up literally 152% from full year 2024. And their full year 2024 numbers was up crazy from 2023. So anyway, I can totally see why the stock has done so well. It's not just, momentum, it's genuine fundamentals improving. How is the valuation looking like? So they traded a 34 forward PE, 34 times next year's net income. That's in line with like what the aerospace and defense companies trade at, like Raytheon, GE Aerospace, Moog. They all trade at like a 34 forward PE. Yeah, United States is 27% of the revenue. They're very geographically diversified from where all the revenue comes from. So yeah, anyway, pretty cool aerospace defense company, Rolls-Royce. What's this terminal? Again, yeah, hey, this is a brokerage, linked in bio there. So Micron, this is your memory shortage play. They're saying this memory shortage is going to persist through 2029. Let's see if there's any news on that. NVIDIA's memory price warning signals sustained demand for Micron. What is this right here? Micron CEO declares AI memory demand structural supply gap unlikely to close before 2028. So yeah. Cloud providers' memory spending projected to surge 68%, benefiting Micron. Okay, anyway. Short seller. Micron researcher warns of worsening memory wall as HBM bandwidth lags AI compute growth. Anyway, I'll go over the bull case and the bear case. So the bull case is, this isn't some peak bubble valuation to me. Let me know what you think. They trade at 20 times net income. And look at the forward PE, only 6.3 times next year's net income. In my opinion, that can easily stretch up to like an 8, 9, 10 before it fully maxes out. And that would send the stock easily to a new all-time high if this is traded at a 9 forward PE or 9 times next year's net income. Look at the forecast here. This is fascinating. And this was record net income, 28 billion net income. It's never even been close to 28 billion before. Look at next quarter. They're going to do 35 billion net income next quarter and 39 billion in net income the quarter after. So that's why we're doing a forward PE, only 6.3 times next year's net income. But I'm not as bearish as Morningstar, but Morningstar does have a good point here. They're saying Morningstar saying Micron's overvalued. While the AI-driven memory pricing upcycle and soaring high memory demand provides robust near-term tailwinds, but the inherent commodity-like nature of the industry and the looming risk of a steep cyclical downturn driven by future capacity overexpansion requires significant caution. So that's the thesis here. Peak ever net income is going to be 2029, 2030. They can't sell this commodity, at 68% net margins forever. So when you do like a 2030 PE ratio, they could be trading at like 25 times 2030's numbers, even though they only trade at 6.3 times next year's net income. It all just depends. This stock trades on the supply chain of the memory industry. So it's kind of, do your own take there. It's certainly, this is in my opinion, it's a great short to medium term play. That is not the kind of stock you want to buy and never sell permanently. I believe, it'll do good through 2030, but then, after that, I would be wondering. Hey, what's up, OG Ghost and Take Profits and Sandro? Thanks for those little TikTok roses there. I appreciate that. I didn't even see those. Thanks for all that. So, and again, I apologize. I am so behind on the chat here. Like I see like BlackBerry stock. Hey, maybe we'll get to that stock too. So, hey, what's up, Rich Future? We'll look at Iris Energy. So Charlie says INFQ. I think this is that quantum company. I think all I remember is they have a great balance sheet, but no real revenue yet. So yeah, here's the cool part. Look at this Fortress balance sheet. So they have $476 million of cash, and the whole company's worth $3.2 billion. So 15% of what you're paying, 15% of the whole market cap is literally their cash on hand. The bad news is they're kind of just now getting their first ever sort of revenue. So when we look at any kind of multiple, price to sales, price to net income, price to free cash flow, it looks ridiculously expensive. So that does take a lot of risk off the table, when that big safety net to have a really good balance sheet like that. But yeah, net income losses, how is the forecast looking? So they're going to lose 21 mil next quarter, 23 mil the quarter after. So certainly not some profitable company yet, but interesting quantum play. I wish I could give you more thoughts on this one besides just a quick glance at their financials. I'd like to see some updated progress on their quantum technology, but kind of interesting there. So Rich Future says Iris Energy. I hate to be bearish. Yeah, hey, we'll try and look at a PAY stock after this. So Iris Energy, this one I am a little worried about. What is this stock here? This is a GPU rental company. So what do? They literally own an insane amount of NVIDIA GPUs. And what do those NVIDIA GPUs do right now? Well, still, as of 2026 Q3, 76% of the revenue is Bitcoin mining. So they mainly just mine Bitcoin with their GPUs. And what's the other part of the business? This has been their growthiest business. That literally, they just started this 4 quarters ago. It was $2 million the first quarter. Now it's $33 million. Instead of mining Bitcoin with their GPUs, they're renting out their GPUs. Unfortunately, this isn't a profitable business. Like, I so wish I could be bullish on this one, but look at these net income forecasts. I mean, they're going to lose 200 million in net income next quarter, 150 million in net income the quarter after. And check out these negative free cash flow numbers. Negative $1 billion of free cash flow, negative 800 mil, negative 200 mil. So there's no free cash flow yield. There's no forward net income PE ratio I can look at. They have, well, I guess decent top line revenue growth, but it's not, there's no barriers to entry. Like, they just legit own a bunch of graphics cards. Like, there's no competitive moat. They do the same thing CoreWeave does. They do the same thing Nebius and APLD and Meta do. So I am worried about the super long-term growth here. I think they got some new GPU deals, or I don't know. Anyway, I just like to give my honest thoughts. I don't love the long-term thesis on that one, though. There is a chip shortage right now, and that really does benefit them. But yeah. Okay. Again, apologies here. What is PAY stock? I've never heard of this one. So this is Paymentus Holding stock. Okay. So they're a $4.5 billion company. They're slightly above their 2021 IPO. So they're kind of flat from 5 years ago, but let's judge them off their financials here. So they've been doing really good, actually. Wow. So if we zoom out, this is what you want to see. Revenue's at a record this quarter, 360 million. The revenue grew 28%. The net income grew by 73. That is pricing power at its finest. If we look at net margin went from a 5% to a 7%. Net margin grew by 34% year over year. Gross margins grew by 3%. So nice little pricing power that they have there. And that's real, yeah. Operating profit grew 104. Net income's up 73. These are great numbers. And another thing that I really like is this monster balance sheet. Like, they got no debt. Pretty much no debt at all. So I wonder what they do. You know what? We'll give a quick glance at their website. It says they're a software infrastructure, cloud-based billing platform. So here's their website right here. Solutions for today's service providers, industry leading in insurance. So the smarter, faster way to secure the smarter, faster, more secure way to pay bills. Patented bill pay assistant. Huh. So anyway, some sort of fintech kind of software financial company. I like it. And the last thing, they were beating good on expectations. Like, the orange line is what the analyst forecast. Notice the past 3 quarters in a row on net income, they crush earnings. The net income is the blue line, what they actually report, is significantly higher than the forecast. Even on EBIT, so that wasn't some accounting fluke. Even on EBIT, some huge beat on revenue. So I can see why the stock literally just in the past couple months has went from $20 to $40. It's doubled. I can understand why now. So, okay, I'm really behind here. Okay. Ingle Markets, you talking about that grocery store? So actually, I had them on my watch list not that long ago. Unfortunately, nothing really blew me away. Man, I cannot find the ticker symbol for Ingles. Um, it's like a local grocery store in a few different states. Very low margin, very competitive industry. Okay, here's Ingle Markets. Think they're like a Kroger, like a Publix, a Walmart. But the bad part is they lack an online presence. They're kind of being out innovated by Walmart and Amazon Whole Foods, where anything you can get at Ingles, you can get on Amazon and Walmart, and they will actually deliver it to you. So yeah, they're kind of they're lucky to have a 2% net margin because it's a very competitive, low margin grocery store business. And the revenue growth has been low single digits, 1.6% revenue growth. That really doesn't beat inflation. Last quarter, it was negative 1%, negative 3%. So you get a nice dividend, a 0.8% dividend yield. But yeah, they're just like a local grocery store. Okay. No, they're trying to get my cookies anyway. I wanted to find a picture of their store. This is their website right here. Anyway, they're actually I really like going into Ingles. It's always a vibe going into an Ingles. It's like going into a Costco. It's like a nice little experience. So TBBB, let's do this one. And then I see, someone said, how you feel about Iris Energy? We looked at Iris Energy literally as the previous stock. So if you want to check that out, this is the best way to support me. If you want to help a brother out, this would mean more than a donation, is actually subscribe to my YouTube channel. I'm trying to build up my subscribers over there. So if you just type into YouTube, Nathan Robert, you'll find my stream. You can rewind it as well if I talk too fast. So anyway, here's TBB Foods. This is a Mexican listed company, so we'll convert the currency to US dollars to get a better idea here. They're at a crazy all-time high right now. I think I remember going over this one. They kind of just sell, they're like a food manufacturer. So, okay, so their website is in Spanish, so we can't really understand this here. But they're like a food manufacturer. They actually own stores, like they're in the discount store industry. Valuation is okay, so there is no net income forecasted. Let's see if that's true. Yeah, so looks like they're narrowing their losses. Actually, if we zoom out over time, well, they're going to lose 22 mil next quarter, 24 mil the quarter after, but check out the revenue. Revenue's growing from 1.2 billion to 1.7 billion. So maybe it's pricing in that massive revenue growth they're about to experience. That being said, it doesn't look cheap to me. The valuation actually looks pretty expensive because there is no net income yet. Oh, actually, we should look at the EBITDA. EBITDA on the left, negative 14 mil. It's about to go positive to 44 mil. So they're actually just now assuming that they're kind of getting net income positive for the first time ever. I assume they're not getting net income positive because they have a bunch of interest expenses. So the EBIT's positive because it's the earnings before interest and taxes and stuff. But I'm assuming they pay a lot in interest from the debt, and that's what's making them EBIT positive, but not net income positive. Hey, Dr. Thunder, dude, thanks for the little gift there. He says, look at CIEN, please. I saw Palantir as well. I want to get to Palantir. And then we'll look at Planet Lab. As Charlie Munger told Warren Buffett, it is better to buy good stocks at a fair price than buy bad companies at a good price. I totally agree. That's a great quote. I always go with quality, and you'll see the results in the long run. So here's CIEN, Sienna stock. I actually don't know what they do. So BofA, which is Bank of America, cut Sienna price targets, cites supply constraints ahead of Q3 results. Key focus areas include backlog conversion, 800 gigabit pluggable ramp, DCOM, RLS, rail growth. Okay, so approximately 5.1 billion of Sienna's 7.7 billion backlog is expected to convert to revenue over 12 months. So that's great. That's invaluable when you have a big backlog like that. So let's see the revenue forecast and net income forecast. Wow, it's actually really good. Net income's growing from 19 mil to 200 million. Revenue's growing from 1.3 to 1.7 bill. Gee, this is great news. Yeah, if we zoom out on the revenue right here, this is their best year they've ever had, most profitable year ever. Revenue grew 39% year over year, and the net income grew by 586. That's insane. Let's see this margin. So gross margins are up 9%. Net margins are up 1,000% from 0.8% to 13%. I'm assuming this is all AI data center demand. So this looks like another kind of AI picks and shovels play. And look at how the valuation just gets cut in half. They traded 130 times net income, but only 62 times next year's net income. That's because the net income is doubling just this year. So like you really want to do a PEG ratio, like EPS is growing 100% this year, What's it going to grow the next year? 30%, then 30% the year after. So like 2029 numbers or 2028, maybe they're trading at like a 20 PE ratio. Morningstar says they're a little overvalued, while the firm stands to benefit immensely from AI-driven data center buildouts. Unrealistic market expectations and underestimated competition from Nokia and Cisco do warrant some caution, they're saying. What are the bulls are saying? Ciena is a major AI beneficiary. Its leading multiplexers, switches, and routers are critical to connecting GPUs across data centers. Large hyperscalers and cloud service customers have reduced Ciena's reliance on CapEx-weary telecom providers. Ciena has opportunities to leverage existing optical expertise, moving deeper into data center by connecting racks and GPUs. So yeah, definitely I can see why this stock has done so well the past 2 years. The net income has exploded to the best it's ever been. Yeah. And the forecasts are saying it's just going to continue to climb higher. Anyway, it's really doing a PEG ratio because they do look a bit slightly overvalued maybe. But yeah, that's a cool one, Dr. Thunder. What's up, man? So Moda says PL stock. This is the Google Cloud or Google Maps satellite provider or imagery provider. They own these Pelican satellites in space that take high definition, high quality imagery for Google Maps. And Google loves them so much. If you didn't know, Google is called Alphabet, like their parent company is Alphabet. Google literally owns 9.89% of the whole company. So Google's a shareholder. They're backed by Google. Here's their website right here. I'll show you a few little images here. Yeah, Clear World with their Planet Super Res. So like if you ever, like 10 years ago, the Google Maps used to be terrible, but now you can zoom in like really close and see some pretty high quality imagery. So the only bad part is the net income here. So here's the bad news. If we go to net income, they're losing a lot of money, like the most they have ever lost. So there is no forward PE to really value this stock, but they're losing net income as their revenue is growing very fast. They're also like the highest ever revenue they've ever had. Revenue, the lifeblood of the company, is up 42% year over year after it grew 9%. This is the fastest growth rate on the entire screen. The growth rate's reaccelerating. We're just really watching these net income losses. Are they free cash flow positive? Yeah, they are. So it's just a net income problem. Like they're going to lose 62 mil next quarter, 62 mil the quarter after. So it's probably going to be a while till they're net income positive, but the revenue growth is explosive and they're backed by Google, which is pretty cool. Morningstar says they're a bit overvalued as well. So hopefully that was kind of helpful there. I do think they're a cool company. There's a lot of cool space stocks. One of my favorite space stocks, I don't own this one, is MDA Space. There's ASTS Space Mobile, there's Rocket Lab, there's Planet Labs. All these are not profitable. They're all losing net income. Well, here's MDA Space actually making like 20 million in net income every quarter. That's a cool one you could put on your watch list if you'd like. Okay, we'll look at some more here. Can you do ISRG? Yeah, so they make those MRI scanning machines, so medical devices, stuff like that. They're on a downtrend right now because of slower North American procedure growth and GLP-1 weight loss fears. So there's, less hospitalizations if, people are being healthier, they're on weight loss prescriptions and stuff like that. So this is what I love about the stock, though. They are a completely debt-free company, literally a monster balance sheet. They have $5.2 billion of cash, $5.2 billion of cash, no debt, and that cash isn't just sitting there doing nothing. They milk it in 1 to 3 week treasury bills. So they literally made an interest on their cash, literally goes straight to the bottom line, 82 million of interest on their cash. That's why in this high interest rate environment, the companies with no debt and a ton of cash are doing great because they can actually earn a high yield on their cash with short-term treasury bills. And also this net income growth is phenomenal. They are also the most profitable they have ever been. Net income's up 23% year over year, making 800 mil a quarter. They even, I believe, do share buybacks. So yeah, here's a quick way to tell. If you look at the growth rate, the green number at the bottom under this, it says net income grew 23% year over year, but the net income per share grew by 26%. How did the net income per share grow faster than the net income? Well, it's the share buybacks. They bought back 3% of the company, so the EPS grows 3% faster. Pretty cool. But the bad news is this might still be a little too expensive for some, but they deserve to be expensive with net income growth like that and a fortress balance sheet like that. They trade at a 37 forward PE or 37 times next year's net income. So yeah, they sell these instruments and accessories. They also service them as well. It makes a nice reoccurring stream. Service revenue is up 21%. Instruments and accessories is up 17%. So Morningstar says they're actually reasonably valued right now. Its unparalleled install base and the robust rollout of the DaVinci 5 platform ensure long-term market dominance while moderating procedure growth and pressures from weight loss prescriptions warrants a balanced perspective. So yeah. So let's see. Intuitive is enjoying tremendous success in general surgery, including emergency settings, which is now highest volume in the surgical area. This opportunity is particularly attractive internationally. Intuitive's foray into bronchoscopy, whatever that is, I'm not even going to try and pronounce it, shows the company isn't resting on laurels and is willing to look in other areas ahead of robotic assistance. Cool. Oh yeah, I've heard a lot about their robotic systems as well. Pretty cool. So what's up, Justin? Said Palantir stock. I wish I own this stock. My biggest regret ever, put L's in the chat, please, is selling out of Palantir. So one share is $185 right now. I sold all my Palantir for a gain at $8.29. So I sold all my Palantir at $8.29. I would be up like 2,000% or something. So literally my biggest regrets ever in the market are selling out of great companies. I sold out. That's just one example. I have a bunch of other examples. Like Robinhood, if you look in the middle, my sell order, I sold 55 shares at $36 a share. Robinhood is now $109 a share. I'd be up thousands more if I didn't sell. So that's why if you look in the top left, I call this my buy and never sell portfolio. I never want to make that mistake again. And this is my experimental portfolio. I have a bunch of portfolios. Like I got my Webull account. I have my Robinhood account. With a bunch of stocks, but this portfolio specifically, once I buy a stock in here, I am never allowed to sell it or trim it. So feel free, go to my channel a year ago. I owned all these exact stocks. Feel free to hit the follow button if you want to help a brother out. Come back to my channel in a year. I will own all these exact companies. It's my little experiment I'm doing on YouTube, and so far it's worked out great. I literally only put 17 grand into this account, and it's grown to a $45,000 position, and I'm actually glad because I've been tempted to sell some stocks, but I'm glad I never have. But sorry, back that story all aside, let's look at Palantir and why they deserve to be at an all-time high. It's not just momentum. The fundamentals are genuinely so good. Palantir's Maven AI platform approaching $1 billion in annual reoccurring revenue. Pretty cool. But this company does a lot of work for the government. Nearly every police station uses Palantir. The Pentagon, the Air Force, the military all use Palantir. Their government revenue grew 79% year over year. That is the fastest growth rate on the entire screen. Government revenues up 79, after grew 49, after grew 23. So their growth rate is like growing. And the other half of the business, selling AI products and services to S&P 500 companies, commercial companies, the commercial side grew 109% year over year. After grew 46, like triple digit growth, another business where the growth rate is literally growing. And they crush expectations every quarter. The orange line is what the analysts expect. Like 811 mil was the expectation. They did over $1 billion in net income this quarter. Every quarter they crush on earnings, and that's why Palantir has done so well. The fundamentals have improved. Look at this pricing power and margin expansion. Net margin grew from a 32 to a 55. So for every $100 that comes in, they keep $55 after tax. And that's the best margin they've ever had. There's not a single metric that's not growing. Revenue's up 92% to a record. Net income's up 220% to $1 billion a record. They have no debt. Like $9.4 billion of cash and absolutely no debt. They're milking interest on it. And they print free cash flow too. Free cash flow's up 120% year over year, growing faster than the revenue. So again, free cash flow margins are expanding, net margins are expanding, crushing expectations, some of the best customers ever. The only bad part is Palantir valuation, which again, they deserve to be expensive, but I'm not paying this. I want to get in Palantir eventually, but I can't pay this valuation. 97 times next year's net income might be a little too expensive. But Morningstar is saying they're still undervalued. Its highly differentiated ontology framework, rapid expansion in US commercial and government segments, and exceptional net retention driven by deeply embedded AI deployments will drive long-term value growth. So yeah, there's your Palantir analysis there. Hopefully that was kind of helpful there. If you're trying to find bargains in stocks that have experienced much more of a dip, you may want to consider that many very smart people have decided that the company's prospects are not good. Well, hey, sometimes the market's wrong, but yeah, I just judge a company off their financials. And if they have good financials, good moat, checks all the boxes, then I'll buy a stock even if it's on a dip, like AppLovin right now. And you still always want to do cautious, like right now with the market where it is. Now's not the time to spend all your cash and leave yourself with no money. With the S&P 500 1% off all-time highs, now's not the time to go crazy in the market, but there are certainly some good opportunities. The S&P 500 is at an all-time high. AppLovin on a big dip I really like. Yo, hey, I see SSRM and Salesforce and stuff. Let me get to those in a minute. We just got a little donation. Appreciate you, my brother. From Peter with the €2 donation says, spoke about Meta lawsuit versus their stock price. I have not looked at Meta yet today, so great suggestion here. So Meta has agreed to pay out $18 billion. So Meta reaches an $18 billion settlement with US states over teen safety claims. Meta projected up to $10 billion annual spend on Anthropic AI models. So yeah, so they finally settled this. Anyway, Meta agreed to pay up $16.6 billion to settle youth harm and privacy claims. Originally, before today, there was like a huge $200 billion potential liability, but they settled. I knew it was never going to be that high, but they settled it. And actually, I watched the stock that exact moment. The stock went up like 2% on the exact moment that they settled this. So the market's happy over the $17 billion settlement. Meta, though, is being punished for CapEx spend because they don't really have a successful LLM model. And it's weird, like Meta's now spending $10 billion on Anthropic models. They're also one of like Microsoft Cloud's largest customers. Yeah, Meta emerges as one of Microsoft Azure's largest AI customers, spending hundreds of millions annually. So the bad part is Meta doesn't really have their own cloud or successful LLM. Like there's OpenAI, there's Anthropic, there's Google Gemini, but there's no real Meta like AI platform. And they did just this quarter $50 billion on CapEx, $49 billion, So I'm actually not worried about that. If it was any other company besides Meta, I maybe would be worried. But I believe, they're actually now renting out their excess GPUs. They're they're getting into the cloud business. Morningstar says Meta's undervalued, highly profitable AI-driven ad monetization. I'm a believer that AI will actually enhance ad targeting and they'll make more ARPU, more average revenue per user because of this. They just disclosed, isn't this crazy? If you're on Facebook in the US, you make Facebook on average $50 a year. Their average revenue per Facebook user per year was $50. Also, expanding compute renting revenue and unparalleled global network effects will drive long-term value growth. I'm not worried about their core business, their core Facebook, Instagram, WhatsApp, Telegram, Threads. I'm not worried about that. The one thing I am worried about is maybe too high of a CapEx spend. Because yeah, all these KPI metrics are great. 3.54 billion daily active users. Pretty much half the world is on a Meta app once a day. And it gets even better when China doesn't really allow people to be on Meta apps. So it's really like 70% of the entire world ex-China is on a Meta app once a day. And you really want to value this one on a forward PE basis. They traded only an 18.4 forward PE. I think that fully prices in all of the CapEx fears. I honestly don't believe Meta will fall 10% more. Like we're close to the bottom on Meta. Like could you see Meta trading at a 14, 15 forward PE? I wouldn't believe it. And if they were, I would be buying the dip. So hopefully that was kind of some helpful analysis on Meta. And full disclosure, I own Meta stocks, so I might be biased when I go over them. And I actually just bought a fractional bit more of Meta. I now own 5.2 shares of Meta. I just bought a little more, 0.2. So yeah, and I'm up 7.6% all time. That's the sad part. I've owned them for like 3 years, and I'm only up 7.6%. But again, they just announced they're introducing ads to Threads, which Threads now has nearly the same amount of monthly active users as X. They're introducing ads to WhatsApp. So thanks again, Peter Borg, for the generous little $2 donation there. Hey, if you'd want to donate to me, actually the best way, or if you become a YouTube member, you get permanent access to my private Discord. So even if you cancel the YouTube membership the month after, you get permanent access to my private Discord. I never promote this because I never like to act like I'm selling. I literally sell nothing. That's the only thing I technically sell, and it's not even sell. It's just a $1 private Discord. You get permanent access. We just talk all the time. Oh yeah, we're just talking about this new Amphenol, one of my favorite stocks. Anyway, if you become a YouTube member, even if you cancel, you get permanent access to my Discord. Anyway, thanks again, Peter Borg. So let's see what's next here. I literally don't have, someone says, can I pay to like learn more? I literally don't have a course. I don't have a book. I don't coach. I literally sell nothing. The only thing I technically have is that little Discord. So what app is this? Hey, this is a brokerage. It's called Moomoo. It's linked in bio, linked in description if you'd like to get this brokerage I'm on. It's just like Schwab and E-Trade. Actually, I have a bunch of brokerages. I have a Robinhood brokerage and I have a Webull brokerage. They ask for a ton of information because it's a brokerage where when you make money, you pay taxes and stuff. It's my favorite one of all time. If I was new to investing or just wanted a second brokerage, I'd get Moomoo, the app I'm on right now, linked in bio, completely free, cost nothing, lower fees than Webull. Okay, so next up, do you have any trading strategy? Yeah, I really don't. I'm not really a trader. I'm probably boring to most people. I don't do options. I don't buy crypto. I mainly just buy high quality growth stocks. And that strategy, I believe, will give you better returns than the crypto people, than the option people, by buying and holding high quality growth stocks. So here's SSR mining stock. What's up, Gavin? Then we'll look at Planet Lab and some of these other stocks. So and thanks for all the follows. I appreciate that. So this is a $7.8 billion company at a crazy, I was going to say all-time high. Technically, they're lower than their 2008 price or 2007 price right before the bubble. So but they've done great the past 5 years for sure. Let's see what they do. So Cripple Creek Victor Gold Mining Company. Marigold, Puna. So it sounds like this is a gold commodity stock. Yeah, the industry is gold. They have 4 asset mine locations. So I bet you with the price of how gold has been, no wonder this stock has done so well. So they're making great profits every quarter. What's their margins? They had a one-time adjustment last quarter. They didn't actually lose 115 mil. But net margin, so excluding that, you usually are rocking like 20% net margins. Let's actually compare this to the literal price of gold, which is IAU. Looks like as you can see, it kind of rhymes together. But I noticed whenever gold goes up, this gold mining company actually goes up more. So maybe it's like a higher beta way to play gold. Yeah, kind of interesting there. Wish I could give you better thoughts on them. Is there a forward PE? Look at that. That's a normal gold commodity multiple. They trade at a 7.8 times next year's net income. Yeah, check out these forecasts. They're going to do 183 mil in net income next quarter, 300 mil the quarter after. Pretty crazy. So the forecasts are great. That's why the stock has gone up so much. So thanks, Burner Mail. Hey, thanks for the little gifts there on TikTok. So, this isn't Planet Lab. This is Photronics. Yikes. Looks like they reported earnings yesterday. Went up to $37, but then lost that entire rally. I wonder what happened here. They're still a really small company. The whole company's only worth $1.7 billion. So that's still like a really tiny company, but the valuation is really cheap. So they beat on revenue. They expected 208. They did 216. They beat on net income. They beat on EPS, and they beat on EBIT. So it was a quadruple beat, triple beat quarter. Looks like they sell integrated circuits and flat panel displays. Looks like the integrated circuits revenue fell 5% year over year. Flat panel displays grew 13%. And what if we zoom out? When we kind of zoom out, that might be the one bad part. This might be why the stock is trading at a low PE ratio. It's kind of low single digit growth, sometimes negative. Like the revenue grew 2.6% year over year, low single digit, just barely beats inflation. But then last quarter declined 0.5%, declined 3%, declined 0.3%. So that might be why the stock only trades at 14 forward PE or 14 times next year's net income. What I do like is this monstrous balance sheet. They have no debt at all, legit no debt, 672 mil of cash. Hold up a minute. They have $672 million of cash and the whole company is worth 1.7 billion. So literally like 33% of what you're paying, 33% of the entire market cap is literally their cash on hand. Technically, they're lower than their stock price in the year 2000. But anyways, semiconductor equipment industry, kind of interesting. That one might be interesting to put a little amount of money in. Hello, what you doing? What's up, Hocus? We're just analyzing stocks here. None of this is financial advice. Always go do your own research. I sell nothing. I had to ban a few people. They have the same name and profile picture as me. I'll never follow you, DM you. I sell nothing. Just on here giving my opinion. That's not financial advice. So next up, user 8 says, can we look at Taiwan Semiconductor? Yes, I love this stock. And even though this stock has had such a massive rally, in my opinion, they are still undervalued in evaluation. They're undervalued in my opinion. Administration considers semiconductor tariffs extending servers, so that might hurt. Taiwan Semiconductor. So one bear case is, so if you didn't know, NVIDIA just designs the chips. Apple just designs their chips. Taiwan Semiconductor is the one that actually manufactures them. And NVIDIA chips are so valuable now that we kind of ban a lot of Chinese companies from buying them. There's a few exceptions, but one of our most valuable assets, chips, are being manufactured 6 feet away from China in Taiwan. And so we're now moving away some of our manufacturing away from Taiwan to Intel back in America. But one thing I love about Taiwan Semiconductor is their Phoenix, Arizona facility. They have a few different US facilities now that manufacture chips. But that all aside, this has the DNA of a multi-bagger. It's so impressive. They are a Taiwan company, so we've converted the currency to US dollars, so all this is in USD. They did 39 bill of revenue, up 24%. On that 39 bill of revenue, they kept after tax 22 billion. So that means their net margin is a 55%. So for every $100 that comes in, they're keeping $55 after tax. Free cash flow is insane. Gross margins are up 15. Net margins are up 30. Like, that's pricing power. Margins are going up year over year. So yeah, I have no complaints. Look at these forecasts. The net income on the very left is 16 billion. On the right, it's about to grow to 25 billion. There's a ton of net income growth happening in just 2 quarters. So you want to do a forward PE. And when you do a forward PE, Taiwan trades at 21 times next year's net income. In my opinion, that's undervalued. But there are some risk, of course. 73% market share. Morningstar says Taiwan's undervalued. Elevated CapEx from hyperscalers, dominating market share in artificial intelligence, computing chips, and leading edge process technologies will drive long-term value growth. So anyway, Goldman Sachs raises price target on global wafer fab equipment spending forecast, names Taiwan Semi as a primary driver. So cool. Yeah, this is a huge CapEx beneficiary as well. Why not get into high quality, smaller mid caps? The return would be so much better. That's not always the case. Each stock has their own story. Like someone might say, like, oh, a company worth $100 million is an easier double than a company going from $1 billion to $2 billion. But that's actually not the case. But I can't understand what you mean with maybe some of the huge mega caps, but it all depends on the financials there. And I do own a bunch of small and mid caps, like Powell Industries. This is one of my original purchases. I bought this company when they were worth $990 million in market cap. So I do look for those all the time. But I'm also like Innodata, they're only worth $1.4 billion. Dave, I bought at a 900 mil market cap. SoFi, I bought at like a 4 bill market cap. So I do love buying a lot of, I love mid caps. I just love stocks with great financials. If they have great financials, I'll buy it. Anyway, so someone says Vail Resorts, if you're still in here. I'm actually not a fan of this stock. This is your ski resort play. Unfortunately, this stock is lower than they were in the year 2016, basically a decade ago. So Vail Resorts is lower than they were a decade ago. And so it's always around wintertime they do good. So every year, as you see, it's so like they have 2 quarters in the summer that do bad, and then in the winter they have their really good net income. But if we go to this on an annual basis, it's kind of, lower than it was in 2018. Like the net income the past 4 years is kind of trended down a little bit. So what's the valuation though? 22 forward PE, it's actually not too terrible. 22 times next year's net income. They're big in, I think, 42 mountain resorts connected. Vail Mountain, Park City Mountains. So yeah, some ski play, and they own some of the hotels next to it. They get the lodging revenue. How's that doing, actually? Lodging revenue is down 9%. So anyway, cool. Not one I'm too interested in. It's kind of a leisure discretionary play. It only works It's winter time, so it's interesting though. Let's do Salesforce. Yeah, I meant to get to Salesforce right here. They reported earnings today, and we're seeing a huge rally in the software sector. So, Salesforce, this is, well, let's actually check out their earnings. I haven't even looked at their earnings. Salesforce beats estimates, raises outlook, and expands Anthropic partnership. They actually took a stake into Anthropic. Salesforce Agentforce platform surpasses 1 billion in annual sales, and they just did a 27 billion share buyback. Raises full year guidance and launches Claudeforce AI partnership. Here's the craziest part about Salesforce. Let's first look at the earnings. So revenue slightly beat. They had a one-time adjustment on their net income, but the EBIT beat by a good chunk. So they beat on earnings by like 5%. Here's the craziest part though. Again, technically the net income didn't actually grow 86%, but this will still get the idea through. The net income grew 86%. The net income per share grew by 118%. So how did the net income per share grow faster than the net income? Well, it's the per share part of the ratio. They just leveraged up their balance sheet to do share buybacks, and they did it at a good price. So look at this. Last quarter, they spent $27 billion solely buying back their own company. They bought back 15% of the entire stock, like down here, like $180 a share. And that is, I guess, very accretive now to the stock that's now $250. So anyway, this is, they print free cash flow. There is some fears around the AI, replacement thesis. Like there were some companies that are canceling Salesforce contracts to make their own in-house CRM, employee management software. But the valuation now is a little high. So you want to do a forward PE. They trade at 29 times next year's net income. But, historically, they beat on net income every quarter. But watch out for these people in chat here. Hold up. Okay, anyway. What does Morningstar have to say? Morningstar says they're undervalued. Its dominance in customer 360 software ecosystem and the rapid monetization of new AI capabilities through Agentforce and Data Cloud will drive long-term value growth. One of my favorite software that they own is actually Slack. If anyone's heard of Slack before, over half the S&P 500 companies use them. Amazon uses them. It was one of the most expensive software buyouts in history. They bought them in like 2021. I love Slack. Salesforce owns them. Anyway, 29 forward PE, I would be cautious, but the share buybacks are freaking wonderful. So let's look at a few more here. Dang, I've been live for a while. If you are enjoying the stream, please drop a like. I'd appreciate that. If you got any stocks you want me to look at, let me know. I'll definitely check them out before I go here. Marvell Tech or Open Door. Okay, the thing about Open Door is I've been to a few Open Doors. They flip houses. They buy houses and flip them. This is doing bad, one, because the financials are bad, and two, because of the high interest rate environment. But the financials are too scary to buy. Here's how I look at stocks. The whole company is worth $3.2 billion. You could buy the whole company for $3.2 billion, but here's what you're buying. You're buying a company that lost $160 million this quarter, which is over 5% of the whole company. $170 million the quarter before, another 5% of the company. $1.1 billion, $90 million. The net income is super negative. And check out the revenue. This is the lifeblood of the company, the sales. Revenue declined 43% year over year. Last quarter declined 37, 32. So it's like look at that downtrend. So I can honestly understand why the stock is the chart looks so bad. And what's the short interest here? So yeah, literally 18% of all the shares are being shorted right now. That doesn't just happen for no reason. That happens when the financials are very bad. So honestly, nothing's really blowing me away there. And if you really love the real estate sector, there's a ton of other great real estate stocks you can look into. Like there's REITs, Real Estate Investment Trust. What is it? Is it CDRE? No. Well, I forget the ticker symbol, but I own some REITs. A REIT is a real estate investment trust where 90% of their assets are real estate. This is CareTrust REIT. I just bought more of them in my Roth IRA. I'll give you a quick little analysis on this one. I own 26 shares of them. I am down 1.6% all time, but they have a 3.7% dividend yield. So you're getting 3.7% of your money back just in the dividend every year. And they do triple net leases on senior housing care facilities. And triple net leases are like 100% margin. They got 95% gross margins, 50 to 60% net margins. They're pretty cool. And the reason they have a 3.8% dividend is because these REITs, by literal law, have to pay out 90% of their taxable income in the form of a dividend, or else they pay huge corporate tax on it. So yeah, their FFO, or funds from operations payout ratio, is only at 76%. And you really do an FFO payout ratio over net income because the net income doesn't include the depreciation or the amortization of, which is super important for real estate assets. I know I'm kind of nerding out here and losing some people, but point being, this is a really cool REIT healthcare real estate company that I own. I also own Iron Mountain. So Maxwell, what's up? He says FDS. Oh yeah, there's Realty Income as well. Realty Income, they're not as growthy, but they're known as the monthly dividend stock. So here's Precision Drilling. I've not heard of this company before. They're worth just over $1 billion. So they're a $1 billion company. Yeah, they have the chart that looks just like a lot of oil and gas stocks. They are a Canadian listed company, so we'll convert the currency to US dollars just so we can better understand them. Wow, the forward PE is a 13. Let's go look at the forecast. Hold up. Yeah, so look at this. For the past 3 quarters, they've lost net income. Well, they're at an inflection point. Next quarter, they're going to make 21 mil in net income. And then the quarter after, they're going to make 31 mil in net income. So you're buying the stock basically as they're getting net income positive for the first time. So Precision Drilling, again, it's in this kind of oil and gas drilling market, so they're very commodity prone. Precision active rig counts, 80 in Canada, 43 in the USA. Anyway, some sort of oil and gas drilling company. You do want to be cautious. Usually these oil stocks, actually the oil stocks never outperform, the tech-heavy S&P 500, but you're not buying it to beat the S&P 500. You're buying it for its defensive nature. Whenever there's war fears, inflation fears, oil does good in those environments, and normally they pay good dividend yields. This one actually does not pay a dividend right now. Another cool one you could put on your watch list, I actually want to do some, I want to do a whole video deep dive into KGS, Kodiak Gas Services. I've looked at their investor presentation multiple times. They're actually fascinating. Get a 3% dividend yield here. And check out the revenue growth here. The revenue, the lifeblood of the company, it's at a record. Okay. Oh, did I look at the wrong stock? Whoops. What is FDS stock? Wait. Oh yeah, I did read it wrong. Okay, shoot, I am slow. I didn't know that about Taiwan. Hey, what's up, Hocus? What app are you using to get all those stats? Hey, I'm actually on a brokerage right now. If you'd like to get it, it's linked in the description, LinkedIn bio. Brokerage called Moomoo. It's where you buy and sell stocks on, but it's completely free, costs nothing. You don't even have to deposit money or sign up with the brokerage to use these analysis tools. But anyway, linked in bio there. Here's FactSet Research Systems. They look just like Salesforce stock and just like ServiceNow, just like Adobe stock. Looks like they were on this massive AI downtrend, but now they've recovered quite nicely. So let me go to their website. I feel like I've heard of FactSet before, but I don't know. FactSet Intelligence is here. AI that's fluent in finance. Most AI needs context. FactSet Intelligence already has your data, workflow, and investment process. What we offer: investment research, portfolio analysis, wealth management. So some sort of software. Anyway, let's go look at their financials because that's what really matters. That's how we'll judge the company. If we zoom out, that's what you want to see. Revenue's at a new record this quarter, but the revenue is kind of growing a little slow. Mid-single digits, like 6%, 7, 6, 6, 5. We would kind of want to see that start to accelerate a little more faster than mid-single digits. And actually, their margins just collapsed. So revenue grew by 6, but the net income fell by 14. And that wasn't some one-time adjustment either. Like even on operating profit, they fell 14. So yeah, gross margins are down by 4% after they fell 6%. And the net margins are down 19% year over year after they fell 11%. So that's one thing to be cautious of, but again, they're still printing free. There's no bankruptcy risk. They're still making a couple $100 million net income a quarter. You do just want to maybe see if AI, how that will affect this company in the long run. Oh, Morningstar covers this one. The bulls are saying FactSet's data feed with wealth management and businesses represent strong growth. While organic operating margins have been range-bound, a higher revenue base may make operating margin expansion attainable in the future, even if progress is choppy. But Morningstar, here's what the bears are saying. FactSet faces competition from well-established players like Refinitiv, MSCI, Bloomberg, S&P Global, as well as software and fintech upstarts. FactSet need to invest in its content and platform could limit opportunity for margin expansion. So that's kind of what the bears and bulls are saying. Okay. Hey, what's up, Larry? Good to see you, man. So he says Helka Mining. Is this that gold? Yeah, this is that gold mining company, and I'll show you the commodity of gold overlaid over this one. Notice they rhyme together, and if we zoom out, whenever gold goes up, looks like this stock goes up even more. So it's kind of like a high beta gold play. Yeah, look at that. Even on the weekly, they consistently outperform actual gold. So let's see what they own. So Greens Creek, Lucky Friday, these are the names of their gold mines. And it looks like half of them are in Canada. And then Korea, 42% of the revenue is from Korea. Well, that doesn't matter. It really just follows the commodity of gold. They are listed in the US, right? Yeah, they're listed in Idaho. Cool. Anyway, 27 forward PE, 27 times next year's net income. Yeah, this free cash flow is great. And the net income as well. If we zoom out, yeah, look at that over time. They're the most profitable they've ever been by far. So the revenue grew by 52, the net income grew by 150. So margins really are expanding. Yeah, look at these gross margins. Gross margins are up 38%. After it grew 86%. Last quarter grew 84, 102. So because whenever gold prices are high, that's going to make them a ton of money. And so this is like a alternative to maybe buying the physical commodity of gold. Actually, I just shared something in my Discord. This is actually one thing to note about gold. Actually, I shared this last night. Did you know, depending on the starting year, if you bought gold in 1972, you've only got annualized returns of 3.9%. 1995, you got a 4.9% annualized return. And as most recently, it's gotten better. Like if you bought gold in 2020, you've gotten 9.2% of your money back every year. So historically, gold, we know, doesn't beat the tech-heavy S&P 500, the actual gold commodity, but it's still, you're not buying it to beat the S&P 500. You're buying it for its safe haven nature, its defensive nature. Whenever there's inflation fears, it crushes, it does better than inflation. Whenever there's war fears, it's a safe haven asset. Pretty cool. Okay. Can you check out Nintendo? Okay. I don't know the ticker symbol anymore. We found it though. So this is Nintendo. They're a Japanese listed company, and the reason I remember their stock is doing so bad is because of memory prices. They're actually a couple months ago, they were losing money for every Nintendo Switch sold because of memory prices. And recently, they just announced a $50 increase to Nintendo Switch prices. So we'll convert the currency to US dollars. So here's some cool KPI metrics. Annual playing users, 130 million. They got Switch hardware sales. Yeah, so last year it was 235. Now it's 185. Oh, that's the full year. So dang, they sold more Switches in of course in 2022. Anyway, let's check out the net. And I actually am a big fan of Nintendo. It's the only way you can get exposure to Pokemon. They own 10% of Pokemon. So if you like Pokemon cards and stuff, it's a cool way. So this is in US dollars right here. As we can kind of see, look at how the net income is. This is why the stock's struggling a little bit. The net income was much higher in like 2020, 2021, when I guess everyone was buying Nintendo Switches at home, and it's kind of trended down, but still, these are great numbers. Over 500, 600 million of after-tax net income a quarter, really good balance sheet, you get a 0.5% dividend, low payout ratio. Morningstar says they're undervalued. The company's renowned intellectual property and exceptionally strong liquidity will drive long-term value growth. So they trade at 23 times net income, but 27 times next year's net income. So it looks like the net income is forecasted to go down a little bit. But anyway, I don't really have any complaints about this one. They were very successful. It's been a while, but y'all remember like the Super Mario movie? They just made their second one. It crushed expectations. Unfortunately, someone said like we can't buy overseas brand as U.S. citizens. We can't buy Japanese brands, or like you can't, or you don't want to because I'm a U.S. citizen. I can buy you can buy ADRs. So Nintendo is an ADR stock. So you want to buy ticker symbol NTDOY. So you can literally buy Nintendo. I can buy Nintendo if I wanted to. So yeah, pretty cool. I am down 18% on FDS. Oh, John, you own that one. Hey, what's up? Faker says Uber stock. Ooh, what's up, Nikita? Any good long-term buys today? Your advice is always bang on. Hey, I appreciate that. Here's my most recent stock purchases. I just bought APP, AppLove, and a little more of them, but my newest stock position, I've never previously owned this one, is MYRG Group. My second most recent YouTube video, I do a whole deep dive into them. My second most recent purchase is Citigroup, ticker symbol C. I love Muller Industries right now. I love AppLove, and I just loaded the boat more on this stock. There's my little B buy order right there. So, and I've been doing some buying in this portfolio. I'm not scared to dollar cost average up on some stocks. Look, there's my little buy order right there. I just bought another share of Amphenol. Even though I'm up 110%, I don't mind buying a little more of an undervalued quality company. I just bought another share of Moog up here. Again, raising my cost basis. I don't mind doing it for these quality stocks. I'm even looking to buy more Amazon. Actually, hold up. Amazon's at a 26.4p. I might go buy a share right after the stream because I've been looking to deploy my cash somewhere. Okay, let's do Uber stock. What's up, Faker? So Uber is another one that I own. So this is a cool software kind of consumer discretionary leisure travel play. Uber is slightly being hurt right now from robotaxi. So if you've heard of Waymo and autonomous driving robotaxis, the thesis is like maybe people will stop using Uber, but that's not what I think. The platform where you go, like the platform with the most users, that's where the robotaxis want to be. It's the platform where you go to book a robotaxi is where the money's made. It's just like Uber. They don't own any cars, but every time you do Uber Eats, they just collect a high margin fee. Every time you do a ride share, they just collect a high margin fee. And recently they've expanded into business to business delivery. Like we had to deliver a part to an office like a couple miles away. We just did it through Uber. They deliver it straight, like they pick it up and deliver straight to where you want it to. So here's their delivery business. It's more than just Uber Eats now. This is their growthiest business recently. Delivery revenues up 27% year over year. After grew 24, after grew 7. So like the growth rate is re-accelerating over here. And the valuation is so cheap. Like all these robotaxi fears, I believe are fully priced in. At 18 times next year's net income, Uber seems very undervalued to me. Even Morningstar saying they're undervalued. Robust network effects from its dual-sided marketplace and sustained growth in its food delivery segment will drive long-term value growth. And this is what you want to see if you're going to diamond hand a growth stock. The revenue every quarter just hits a new record. Record revenue and most importantly, record profits. They're by far the most profitable they've ever been, making over $1.5 billion in net income a quarter, and the free cash flow is even better, making over $2 billion of free cash flow a quarter. So I really don't have any complaints about Uber. It's one you still want to be cautious of that robotaxi fear, but I'm not. That's why I have it as like a decent position. I only have it like a $700 position, but here's their monthly active consumers. Not just monthly active users, but monthly active consumers grew from 180 million to 208 million this quarter. So pretty impressive stuff. They just acquired Delivery Hero. Uber, they're not going to get out innovated by robotaxis. They're investing themselves. Uber expands autonomous vehicle partnerships with Baidu, Apollo, and Dubai, and Pony AI in Europe. Uber launches formal takeover offer for Delivery Hero. What is this? Dutch data protection fined Uber 800 million euros for GDPR violations over automated driver account suspensions. Know what that means, but it looks like Uber called this disproportionate, plans to appeal. Anyway, there's some news around Uber. Again, I apologize if I'm missing some stocks here. There's so many great stocks I want to see. I want to analyze. So, what's up, Lopez? Let's do Marvell. And when someone said, what app is this? Hey, this is a brokerage. Again, it's where you buy and sell stocks on. If you'd like to get it, it's linked in my bio there, a brokerage called Moomoo. So here's Marvell Technologies. They are now manufacturing chips, manufacturing TPUs for Google. And this opportunity, according to this third line here, Marvell Tech and Google expand custom AI partnership and up to $120 billion revenue potential for them. Multiple analysts raise price targets and maintain buy on Marvell following Google custom chip deal. So with this new Google deal, I believe these estimates are going to get revised higher. Like they haven't priced this in yet. Like if we look on the right, like the orange line is what the analysts forecast. I believe they're going to beat on these numbers the next couple quarters. And these revenue forecasts are already great. Revenue's $2 billion on the left. It's going to grow to $3 billion. EBIT or net income is basically growing from $750 to $1.1 billion. I mean, there's still massive growth. The only kind of bad part is the valuation. They currently trade at 96 times next year's net income. So even on next year's net income, 96 times next year's net income is still a little too pricey for me, but they're still Morningstar says they're undervalued because they're going to CAGR, compound annual growth rate, their EPS like 40% through 2030. So they're growing net income by 40% this year, 40% the year after, 40% the year after. So when you do that, like using 2029's EPS, maybe they're trading at 20 times 2028's numbers or something. So Morningstar says they're actually undervalued. A strong position in optical chips, accelerating custom AI silicon deals with major hyperscalers like Google and Amazon, and an expanding data center networking portfolio will drive long-term value growth. If you didn't know, they make custom chips for Google and Amazon's TPUs. They actually provide NVIDIA fiber optics as well. So I think NVIDIA took a stake into Marvell. I'm pretty sure they did. If not, they have some huge partnership, but okay. Is Amazon a good buy right now? Absolutely. Can you talk about AppLovin? Yeah, let me do a quick analysis on AppLovin. We've kind of already analyzed it a few times on the stream, but let me give you my favorite things about this company. So if we look at this stock right here, they're on a massive 40% downtrend from their peak. Out of all the stocks, I just bought this stock, by the way, literally days ago at $307 a share. Out of all the stocks on a 40% downtrend, this is the one to buy, in my opinion, because there's a complete disconnect between their financials and the stock price. If we look at revenue, this is phenomenal. Revenue grew 52%. Look at these growth rates on the bottom. Revenue's up 52, after grew 77. But check this out. The net income is what I love. Revenue is $1.92 billion. On this $1.92 billion, they kept after tax $1.27 billion. This is their most profitable quarter they've ever had. Like the stock's lower than it was 2 years ago, but the net income is the best it's ever been. And that's real after-tax net income because before tax was 1.49, after tax was 1.27. And that means their net margins are a 65%. So for every $100 that comes in, they're keeping $65 after tax. That's why out of all the stocks on a 50% downtrend, I want to own the one with these sort of financials, like this sort of DNA, 65% net margins, growing revenue 52%, growing net income to a new record this quarter, most profitable quarter ever, and the growth is not done. This quarter is $1.27 billion. Check out these forecasts. Next quarter, it's going to be $1.36 billion. The quarter after, $1.54 billion. This stock is called ticker symbol APP. This is AppLovin. And when we go to the valuation, worst case scenario, in my opinion, not financial advice, the worst case scenario is this stock falls another 10%. They trade at 16 times next year's net income, 24 times trailing 12 months net income. So like even Morningstar saying they're undervalued. The company's powerful Axon advertising optimizer and successful expansion beyond gaming into e-commerce and connected TV will drive long-term value growth. So yeah, I mean, anyway, I might be biased because I own that one and I just bought that one, but I really like that one. I bought AppLovin at $300 a share. I'm very long. Hey, nice. So here's my position. I'm still down on this stock. So you could actually get in at a better cost basis than me. So I own, there's my little buy order right there. Bought another share at 307 and it's, but see that blue line? That's my cost basis. My average cost is 350. So I am still down 10% all time, but that's one I'm not worried about because it'd be a different story if the net income and free cash flow and stuff was like missing and going down, but it's not. The financials look great to me. So yeah. Anyway, let's look at some more stocks. Ian says Dell. Let's do this so long-winded. Hey, what's up, CIP? Hey, didn't you have a, he said, oh, NLST. Let's do Netlist. And then we can say, what's up, man? And then we can do, remind me to get to Dell. Dell is actually pretty fascinating. So here's Netlist right here. Wow. I actually forget what this company does. They're at a multi-year high right now. Technically, they're lower than they were in 2021, but something has happened where this stock has had a phenomenal rally. Can we get any like forecast here? So great forecast. You know, revenue on the left is 75 mil. It's going to grow to 184 mil. Next quarter is going to be 308 million of revenue. You know, yeah, if we zoom out, revenue's never been close to 300 million before. So looks like they're a bit leveraged though. Looks like they have more liabilities than assets. What's the net income forecast? So actually there's no analyst covering it. Look how they've narrowed their losses. Like if we zoom out, they used to lose a lot more net income And now they only lost 2 million this quarter. So it's kind of like you're buying this company as they're getting net income positive for the first time, as their revenue's about to surge up. Let me go to their website. So they got 72 employees. They do SSD. Okay, that's starting to make more sense. They are partaking in the Samsung settlement delivers a 900 million licensing agreement and 1.5 billion in product supply to Netlist. So they are part of the memory shortage. So Congress should pass the Restore Patent Rights Act to empower true innovators. I haven't heard about that. Restore Patent Act. Netlist wins 455 million in patent infringement trial against Micron. Whoa! I'm going to screenshot that. Wow. So Micron infringed on their patent and they won 455 mil. I wonder if that goes straight to their bottom. They must have some sort of good proprietary technology then. Anyway, I wish I could give you better thoughts on this, but it looks the stock is moving very similar to the memory sector. That's why I like going to their website. You find little facts like that you'd never really, you can't find those facts in just looking at the balance sheet and stuff. Okay. So there's Dell and Supermicro Computer. Let's do Dell. They both do the exact same thing. So a lot of companies, are making their own like DIY servers, and Dell, whenever you go buy a bunch of NVIDIA chips, they do all the work for you. They come and install it, put it in the racks, and it's this infrastructure business that's done phenomenal. And here's what's crazy. Dell is at a crazy all-time high right now. Even though Dell is at an all-time high, they're still undervalued in my eyes. Because of this forward PE of a 27, they trade at 27 times next year's net income. That seems fair. Morningstar says they're undervalued. A massive vertical ramp up in AI infrastructure development or deployments, a resurgence in general purpose servers driven by agentic AI, and why have I never seen that word? Exemplary capital allocation efficiency. I have heard that word. Like, I just can't pronounce it when I see the letters. Anyway, exceptional capital allocation efficiency will drive long-term value growth. Here's why the 27 forward PE is fair, in my opinion. If you look at their main business, infrastructure solutions, this is insane. Business grew 181% year over year. That is the fastest growth rate they have literally ever had. So growth rates reaccelerating, and check out this specific quarter. This is why, if you're wondering, why was there such a massive gap up this day? This is the day they reported these numbers. Analysts had forecasted 35 billion of revenue. They did 43 billion. And not just a beat on revenue, check out the net income. And this is real, not some accounting fluke. Even on EBIT was a double. They expected 1.74. They did 3.4. I mean, no wonder this stock has done so well. Net margin grew from a 4 to a 7.8. Revenue's up 87, net income's up 256, and they're even doing massive share buybacks. See, the net income grew by 256. The net income per share grew by 282. How did the net income per share grow faster than the net income? Well, that's because the per share part of the ratio. If we look right here exactly, look at this. They're spending billions of dollars a quarter solely buying back their own stock. And, they pay 400 million in a dividend every quarter. They buy back billions of their stock a quarter. So that being said, I would probably want to wait. I would want to wait for a better cost basis if I didn't own this stock. But if I already own this stock, do not trim or sell this stock, in my opinion. This isn't some peak bubble valuation of 27 forward PE with triple digit growth and margin expansion and pricing power that they have. So, let's look at a few more here. Butler National. Hey, if you look, I literally right before the stream, literally 10 minutes before I started the stream, I uploaded a TikTok covering BUKS stock. Hey, hit the follow button if you'd like. I'm trying to make more TikToks. I mainly just do live streams, but I made a dedicated TikTok. Oh, I meant to upload that to YouTube Shorts. Well, I'll do that after this. Anyway, this stock, I almost promise will interest you. If you look in the top right, this whole company is worth $265 million. That's a micro cap, but here's the thing. There's a ton of companies out there worth $265 million. Out of all the companies worth $260 million, I want to buy the one that makes net income every quarter. They made $6.7 million. That's a couple percent of the whole market cap, and that grew 98% year over year. I mean, this is incredible. Revenue's up 27, like the revenue's 26 mil. They kept 6.7 mil on that. They rock literally 24% net margins. So out of all the companies worth 260 mil, I want to own the ones with 20% margins, making net income every quarter. And if you're wondering what they do, they're focused on aerospace engineering, aircraft modifications, electronics, and professional management services. So yeah, some sort of aerospace defense company. Pretty cool. They are an OTC though, so they're not available on Robinhood, but you can buy them on Moomoo. Yeah, pretty cool company. I think they're going to convert. Anyway, pretty cool stock there. Not smart, but if I buy a FAFU stock, I want the best. I also want the one that appeals to kids who are probably not in GLPs. Yeah, hey, McDonald's dropped even a bit further from usual support zone. What do you think? I actually, in response to McDonald's dropping, I just bought another share. So yeah, if we look, poorly timed, but yeah, if you look at the very top, just bought a share at $267 a share, and McDonald's is $260 today. The QSR quick service restaurant industry is really struggling because one is the weight loss prescriptions. People are becoming healthier. They don't want to eat, fast food and stuff. But McDonald's, out of all the fast food restaurants, McDonald's is the best one. RIP Wendy's. Did you know Wendy's is lower than their 1997 IPO price? Yikes. Same with Jack in the Box, same with Red Robin, same with Krispy Kreme, same with Cracker Barrel. The list goes on. They're all lower than their 2000 stock price. And here's the thing, though. Out of all the food stocks, I'll be quick about this one because I know it's probably boring to a lot of people, McDonald's, but this isn't a restaurant stock, technically. This is really a real estate and royalty company. Whenever you go to a McDonald's, 80% of those McDonald's are literally franchises, and those franchises don't own the land under the stores. This corporation, this stock owns the land under them, so all the franchises are actually tenants that pay rent back to McDonald's, and also all these franchises have to pay a 4 or 5% sales and marketing royalty. So 5% of every sale that they have goes back to McDonald's as a royalty. So no restaurant ever has 30% plus net margins every quarter. That's because they're really not a restaurant. They're a royalty real estate company, and that's why I like this one the most out of all the restaurant stocks to buy. They technically had a record net income this quarter. That being said, this is not the type of stock to outperform the tech-heavy S&P 500. You're not going to beat the S&P 500, but in my opinion, you'll get 6 to 7% of your money back a year. You get a nice 2.8% dividend with McDonald's. So I do own that one, and I trust them. So they're actually one of my larger positions. I got 21 shares or $5,500, but I am down and bad on them. I am down 7.3%, but not including dividends. But yeah. Okay, I think I just talked myself into buying 75 shares of McDonald's. I don't know what your total portfolio is, but I wouldn't exactly be overweight in McDonald's. I don't know how much time you have to invest. McDonald's, won't beat the S&P 500, but it's just a nice stock. You can sleep well at night knowing we'll be fine, especially if we start to see a recovery in the restaurant sector. And also McDonald's has the best rewards program. And anyway, I have the McDonald's app. It's great. Yeah, what's up, Monkey D. Luffy? Good to see you, dude. He says Wingstop too. Yeah, Wingstop is another one where, look at this. They're on worse than McDonald's. They're on this massive downtrend. Wingstop is another royalty model company where I wonder if I can find the breakdown here. But yeah, look at this. For Wingstop, 44% of the revenue is literally royalty revenue, these franchise fees, advertising fees, and then they own a good chunk of their stores. So 21% of the revenue is their company-owned stores. So this is another one where they don't have McDonald's 30% net margins, but they're rocking 16% net margins every quarter, and nice little net income growth over time on them. So yeah, I've actually never, this is sad, I've never lived near one. I've never been to a Wingstop, but I heard they got the best ranch ever. So anyway, yeah, these are being hurt by a lot of these weight loss trends and input cost inflation, commodity inflation. So, okay, can you cover Iris Energy just for earnings? Well, hey, actually, I'm not going to cover them. I sadly don't have really much good to say. He says he just bought calls. I kind of feel bad. Well, the thing is, this stock will probably do good for the next 2 years, but to buy and hold this one forever, just buy shares and long the stock, I really wouldn't do, because this is a no barrier to entry, no moat business that is a big money loser. So what does this company do? I'll be quick about this one, but they just literally all they do is own an insane amount of graphics cards. They own a bunch of GPUs. What did those GPUs do? Well, as of Q3, 76% of their revenue is Bitcoin mining revenue, but recently they've gotten into renting out GPUs to cloud companies. So they started this 4 quarters ago. It was $2 million. Now it's $33 million. So they're renting out GPUs to cloud companies, but I can't value them the way I'd value any other company. There is no free cash flow yield. There is no forward PE. Like, this is why, sadly, I would low-key kind of stay away. There's a lot of good AI picks and shovels plays out there, but again, there's no barriers to entry. There's no moat. They just own chips. And look at these net income forecasts. They're going to lose $202 million in net income today, or they're about to report earnings today. They're going to lose $150 million the quarter after. And look at these free cash flow losses, hundreds of millions and billions of free cash flow losses. So that's why I'm a little worried, That's just my honest thoughts. I feel bad you say you bought calls, but hey, that's just my honest thoughts on them. Hopefully that was kind of helpful, but yeah, sorry about that. What's up, Norbero? DKS, is that Dick's Sporting Goods? Hopefully I don't get banned. Dang, what happened to them? So they just had a nasty gap down, 185 to 130 bucks. Let's see what happened, or let's look at the earnings report. So they slightly missed on revenue, they slightly missed on net income, and slightly missed on EBITDA. So yeah, they did miss on every metric, but revenue grew 53% year over year. Technically, that's propped up because they bought Foot Locker, so that's why the revenue growth was so fast. Ooh, so yeah, here's the thing. Revenue grew by 53. The net income declined by 17. So if we go to margins right here, gross margins fell by 6%, net margins fell by 46. So after they acquired Foot Locker, margins have been down. Yeah. So that happened exactly 4 quarters ago. Look at that drop off from 4 quarters ago exactly. Ever since they bought Foot Locker, their net margins were from 8 to 10% every quarter to a low net margin. I don't know. So, oh yeah, here's the revenue breakdown. There you go. So I don't know about this one. I wish I could give you better thoughts. It's, you buy sports equipment, you buy shoes on 11 forward PE is really cheap. One stock that's similar, that's actually surprising me, is Ross. Let me type it in. You ever heard of Ross Dress for Less kind of stores? So this stock has crushed the S&P 500. I mean, and they just boring shoe store. They kind of sell everything, bed accessories, ladies, men's shoes, accessories. So anyway, that's another interesting one. Another one I normally don't like this industry. I would never want to own Macy's. I never want to own Gap or Bed Bath & Beyond. Look at Dillard's though. Dillard's in 2019 was $70. Now it's $630 because they don't spend all their money paying out a dividend. They do massive share buybacks and do special dividends. Check out these special dividends. This will fascinate you. So normally every quarter, if you look, they pay 30 cents, 30 cents, 30 cents. But look, then they paid in the very middle a $30 dividend. Every year they do a special dividend. The year before they did a $25 special dividend. So for literally every one share that you own, you just got paid an extra $30 in for me, it's tax-free qualified dividends. What do I mean by, I can't wait to share this with you. Here's why investing favors the low income. If you're like me, if you make under $48,000 a year, even in your taxable account, did you know dividends are completely tax-free? Unlike interest income, unlike bond and CDs that are taxed as short-term capital gains, did you know dividends are taxed at long-term capital gains? And if you make under $48,000 a year, long-term capital gains tax is literally 0%. How do I know? I've done my taxes the past 3 years in a row. I paid 0 taxes on all my dividends, even in my taxable account. So that's why I love dividend stocks. And another cool fact is, that's why I don't mind having a taxable account. Even if you own a stock for over a year, it's taxed at long-term capital gains. I could literally sell all my Google right now for a $3,100 gain, 108% gain, and all that money would be completely tax-free, because I make under 48K a year and it's long-term capital gains taxed. Pretty cool. So I just like to share that. Of course, not this for the US, always go do your own research, but literally just Google 2026 long-term capital gains rate income tax bracket. It's literally 0%. I've actually made one of my more popular TikToks a while back was going over that. Anyway, what's up, Emaz? Reddit should be able to recover. Oh, I definitely think it will. Is Powell still a good buy? Powell is not an amazing buy. It could be a good nibble. Hey, we'll look at ONDS and Broadcom before I go here. Dang, we've been live for almost 2 hours. If you did enjoy it, please drop a like before you go. If you want to help a brother out, the best way to support me would literally mean more than a donation, would be to check out my YouTube channel. I'm trying to build more subscribers over there. So just type into YouTube Nathan Robert, you'll find it. Day trading is not long-term capital gains. Yeah, exactly. I said long-term capital gains. So you have to own a stock for over 1 year, and then when you sell it, it's long-term capital gains. And if you receive any dividends in your taxable account, it's taxed at long-term capital gains, so 0%. But yeah, if you day trade, sell something before a year, it's taxed at short-term capital gains. Anyway, let's look at Astera Labs right here. This is a huge AI data center beneficiary. If you have one data center on Microsoft Azure Cloud and one data center on AWS, they make the communication equipment where you can send data back and forth through the data centers, through the different clouds. So let's see if there's any news here. Revenue growth of 104%, fueled by Aries, Scorpio, and Taurus products. This has such good financials. There's no wonder this stock has done so well. Like, this is what you want to see. In 2023, literally they did 10 mil of revenue a quarter. Now this quarter they did 390 million. It grew triple digits, 104%. Revenue's up 104. Net income's up 198. So on this 390 mil of revenue, they kept after tax 153 million, which means their net margins are 39% this quarter. Ridiculous. And a huge safety net, something that takes a lot of risk off the table, is the fact that they are debt free. They have no debt. And they have a bunch of cash on hand, $1.25 billion of cash, record cash on hand, growing top line revenue triple digits, growing net income even faster than triple digits, meaning net margins are going up. So yeah, they basically make semiconductor communication equipments, this kind of stuff right here. It's kind of hard to explain, but yeah, retimers, gearbox, all that stuff. Anyway, Astera Lab, the only bad part is it's a little expensive today, but again, this is the type of stock that deserves a high forward PE, deserves to be expensive. They traded only 65 times next year's net income. So yeah, pretty cool. 65 times net income is a little expensive, but it's getting cut by more than in half from the trailing 12 months net income. Weekly dividends are better. Well, the dividend, I don't know about all that. And if all the weekly paying ETFs don't really beat the S&P 500, because they do, those are covered call ETFs. Why do you like app if it missed on EPS? It missed on EPS by like 2%. I mean, and the stock fell, they missed on net income by 2%, the stock falls 25%. Like, there's a huge disconnect, and the forecasts are phenomenal. There's a ton of reasons. Actually, if you look at my second most recent YouTube video, I do a whole deep dive into AppLovin and some other company as well. But actually, I go over my most recent stock purchases. I go over MYRG. I deep dive into my newest stock purchase. I've never previously owned this stock, MYRG. I deep dive into why I bought this stock. Great industry, 25 forward PE, $3.2 billion backlog, and the whole company is worth $4.8 billion. Margins are going up. I won't spoil it. If you watch my second most recent YouTube video, you'll love this stock. I almost promise. And AppLovin's the other stock I deep dive into in that video. Ticker symbol APP. It's another one I just loaded the boat on, bought another share down here. Undervalued. Okay. So someone said ON stock. I think it's that shoe company. I don't remember. So actually they're a Swedish company, so we'll convert the currency to US dollars so we can understand this a little better. Let me make sure oh yeah, footwear and accessories. So yeah, they sell shoes. What kind of shoes? Oh yeah, I don't really wear that brand of stuff, QC or whatever. But On Running. Anyway, if you've seen these shoes before, this is their stock right here. And it's not just them that's struggling. Like, if we zoom out, this chart looks really bad. It's not just a them problem. It's a Nike problem. It's a Lululemon problem. It's an Under Armour problem. All these companies are struggling. But they actually still make good net income. Actually, the net income's the best it's actually ever been. They're making over, like, if you average it out, over 100 mil in net income a quarter. But what happened? Okay, so they missed on revenue. They missed on net income. And missed on EBITDA. So that's why the stock most likely gapped down. They triple missed, but they didn't miss by too much. What's the forward PE? An 18 forward PE. Here's the thing, like, consumer trends change all the time. Morningstar says they're undervalued. Continuous product innovation and its proprietary cloud tech technology, it's a disciplined premium brand positioning, and robust expansion in both direct-to-consumer and international markets will drive long-term value growth. So interesting there. But yeah, if we look at like a Nike stock, I feel bad for Nike. Nike is lower than they were in the year 2014. They're lower than they were a decade ago. And I actually fully sold out of Nike. I foresaw this coming when their margins started to decline and revenue growth was nothing anymore. Sold out of all my Nike shares. Not one I'd want to own again. Lululemon right now, and there's also some international tariffs, but yeah, Lululemon also lower than they were, like dang, lower than their 2017 stock price. So, it's not just a on problem. And Under Armour is probably the worst one. Under Armour is lower than their 2005 stock price. And it's funny, my marketing class is like, one of the stories is how Under Armour became such a great company that I'm like, have you seen their stock price? Must be some old textbook stuff. But what's up, Plasma? He says, okay, let me do Reddit really quickly, and then we'll do SHLS, and then I gotta go because I've been live for over like 2 hours now. Yeah. Hey, High Stakes, what's up, man? I appreciate all those. Dang, you left like 30 freaking roses. And I missed out Burner Mail as well, and Gavin Core. If you're still in here, I always forget to say it, but thanks for all those little gifts there. I do appreciate that. McDonald's opinion, yo, High Stakes. I feel we literally like not even 3 minutes ago just did a whole deep dive into McDonald's. So if you want, you can go to the YouTube stream and rewind it. But I have only good things to say about McDonald's. I think it's a good cautious buy, and I actually just bought one more share of McDonald's. What app is he talking about? Hey, this app I'm on is linked in bio. Maybe he was talking about the AppLovin APP. But yeah, if you want to get this brokerage I'm on, the app I'm on right now, it's linked in my bio there. So, and then hey, dude, try not to spam there. Okay, we'll get to OnDesk. Hey, yo, dude, if you have a stock, give me the ticker symbol. Give me the ticker symbol for a stock if you want me to analyze it, unless it's some popular mega cap. So anyway, here's Reddit right here. I love Reddit. I do own Reddit as well. But Morningstar saying they're undervalued. Continuous monetization gains driven by improved ad targeting and the unique value of its user-generated data for AI training will drive long-term value growth. They have a deal with Google Gemini where Google Gemini is training their LLM on Reddit's data. Super high-quality data. My favorite part is this forward PE. Did you know Reddit only trades at 23 times next year's net income? And another thing that takes a ton of risk off the table is the no debt. Reddit has $2.8 billion of cash. What's the whole company worth? Is it under 28 bill? Literally, if you buy Reddit right now, 10% of what you're paying is literally their cash on hand. So you can honestly subtract like 10% from this forward PE. They traded basically 20 times forward PE, assuming they don't beat on earnings. And every quarter they do beat on earnings. Check this out. This is why Reddit isn't some meme stock. Reddit genuinely is a growth monster. They're known as like one of the last real places on the internet. Reddit's revenue, the lifeblood of the company, grew 61% year over year. After it grew 77, after it grew 53, they're on a streak of growth, and it costs nothing to run Reddit. Their gross margins is a 91%. And then now their net margins are over a 30% every quarter. So for every $100 that comes in, they're keeping over $30 after tax. They're making over 250. Look at these triple-digit net income growth rates. They're the most profitable they've ever been. They have no debt. They have expanding margins. The ARPU's growing, their average revenue per user. I have nothing bad to say, and their high-quality data can train LLMs. Just got off school, I'll watch the replay. Hey, what's up, Plasma? Hope you had a good day at school. SHLS stock, he says. Showall's Technology. Then we'll get to ONDS. Bought 1,000 shares today at 262. Oh, of McDonald's. Dang! Of McDonald's? Jeez, man. As the last stock on the stream, maybe we'll cover McDonald's, even though we just covered them. But, that one, it's like the very best restaurant stock to buy on the dip. You now get like a 2.9% yield, dividend yield. Like there's the little GLP-1 fears, but that's not scaring me. So yeah, I actually also just bought one more share. So now I own 21.4 shares. Pretty cool. So anyway, here's Showall's Technology. I've never heard of this one, Plasma. Thanks for showing this one to me. So System Solutions and Components. How's that growing? Wow, components business grew 86% year over year. System Solutions grew 35%. So when we combine both of the businesses, revenue's up 47% year over year. That's record revenue. It's never been higher. 163 mil of revenue. And yeah, they kept 12 million. Since they lost money last quarter, they didn't actually. They had a little one-time adjustment. So actually, these forecasts are great. They're going to make 15 mil next quarter, 17 mil the quarter after. Where are they selling this? All in the US. So this forward PE is actually very inexpensive. 18 times next year's net income. That is really cheap. So their company a design of mission critical solar. Oh, so they're a solar component company. Let me go to their website. Maybe we can get a little better idea of what they do. View our projects or so yeah, Gemini Solar plus storage. Okay, reject all cookies. Approximately 30 miles northeast of Las Vegas. It stands as oh my goodness, bro. What just happened? Well, I was trying to read what they say. Powers 10% of Nevada's peak power demand. Anyway, it looks like some solar company. Anyway, cheap valuation there. Huh. Interesting, yeah. Okay, I'll do ONDS. This is a big acquisition company. So this is like aerospace defense version of MicroStrategy. They've done like 7 acquisitions just since this year. OnDesk completes $33 million acquisition of Iran Defense. So yeah, if we look at how much they're, well, they basically issue shares, they dilute shareholders and then buy a bunch of companies. Like they diluted all shareholders by $1 billion last quarter, actually $2 billion in the past year. And the whole company's worth $5 billion. So they've diluted every shareholder by like 30% plus. But what do they do with all that money they raise? They go buy companies with it. So yeah, they bought a company for 300 mil this quarter, 500 mil the quarter before, 300 mil the quarter before. So if we zoom out to the revenue, a year ago, this was some startup, literally a year ago, doing 4 mil of revenue a quarter. Now this quarter, they did 83 mil of revenue, all because of acquisitions. So they did 83 mil of revenue this quarter. Check out the forecast. Next quarter, they're going to do 148 mil and then 250 mil the quarter after. The only unfortunate part is they're still quite far away from profitability. They're going to lose 71 mil next quarter, 50 mil the quarter after. So there is no forward PE to really value this company on. But basically what they do is they just issue a bunch of stock and then go and buy aerospace and defense companies specifically with the money. So yeah. They have a big backlog as well. What's the backlog right here? 175 mil in new orders. Reported backlog of 600 mil. Oh, cool. Yeah, they acquired Cyberhawk as well. They've literally done like 10 acquisitions in the past year and a half. Like it's insane the companies they acquire, but they have to issue a bunch of stock to do it. So, which website is this? Hey, again, this is a brokerage I'm on. It's where you buy and sell stocks. My favorite one. You don't even have to deposit money to use the analysis tools. But yeah, if you want to get this brokerage, it's linked in my bio there. Okay. Last stock. Dan, we've been live for over 2 hours now. If you did enjoy, please leave a like before you go. It'd help a brother out. And the best way to support me, more than a donation, would be subscribe to my YouTube channel. Type into YouTube Nathan Robert, you'll find the stream. If you missed anything, you can rewind the stream as well on YouTube. And so here's McDonald's right here. Again, all the restaurant stocks are on a massive dip. And this one, they have not missed on any metrics. It's just like expectations. Like actually the forecasts are still great. McDonald's is only falling because the whole sector is falling. And this is the best one in the sector because McDonald's, I know it sounds boring to a lot of people, but McDonald's is really not a restaurant company. They're a real estate and royalty company. All the McDonald's stores you see are actually 80% of them are franchises. So all the franchises as well don't own the land under the store. The corporation does. So all these franchises pay rent back to the parent company, so they're tenants, and they also pay royalties. Every McDonald's, because they benefit from the hundreds of millions and billions of marketing the corporation does, they all get free advertising. They have to pay 4 to 5% of every sale back as a royalty to this business. No restaurant runs at 30% net margins every quarter. That's because McDonald's is really a real estate royalty company. The original founders, like, you can't build a massive empire collecting 10 cents on every burger. You got to own the land. You got to franchise. You got to collect royalties. And that's why I love this one. Morningstar says they're undervalued. It's unparalleled global brand recognition, massive scale-driven cost advantage, and aggressive digital loyalty expansion will drive long-term value growth despite some near-term consumer traffic pressures. They finally brought the value back. Have you heard of the $5 meal deal? You get a McChicken, a small fry, 4 nuggets, and a small drink. It's literally the best value. I've been to every like fast food restaurant. No other restaurant can beat the $5 meal deal at McDonald's. So anyway, they just brought back the fried apple pies. They just did some new Red Bull drink that I went and tried. It was actually pretty good. So that's kind of my thoughts on McDonald's. This will not beat the tech-heavy S&P 500, but you should get 6 to 7% of your money back a year, 2.5% from, actually 2.8% from dividends, 2% from share buybacks, and then 2.5% same-store sales growth from opening new stores. So anyway, fascinating company, and they're boring, but that's the kind of, I'm okay with that. Sometimes it's the boring businesses that do really good, kind of like a Waste Management. So I do own 21 shares. So yes, Finn, we've looked at AppLovin like 5 times already today, so I'm not going to cover them. But if you do want to see my even better analysis on AppLovin, check out my second most recent YouTube video. I literally deep dive entirely into AppLovin. I deep dive into MYRG. Those are the only 2 stocks I analyze. Type into YouTube Nathan Robert, you'll find my channel. But let me end this with this quick stock portfolio update and just tell you again, none of this is financial advice. Always go do your own research. I literally sell nothing. There's no way to learn from me besides watching the streams for free. I don't coach, I don't teach, I don't sell anything, no course, book, WhatsApp, nothing like that. So anyway, here's my Webull portfolio all time. I love being fully transparent. I go to a ton of other streams. No one's like transparent with their buys and their portfolio performance and their stock performance and stuff. Anyway, all time I'm up 34% or $5,100. These are all the stocks that I own in here. A lot of these are kind of popular like AMD, Robinhood, Microsoft, SoFi, Reddit, AbbVie, Uber, Southern Company, Netflix, Citigroup, MYRG is my most recent purchase, and AppLovin as well. So I'm kind of being quick here, but yeah, then I have in the top left, I call this my dividend only portfolio because every stock in here must pay a dividend. And here's my lifetime gain on every stock. So McDonald's has really slugged us the past year to date because the whole industry is, but yeah, we're down 7% on 7.4% all time on McDonald's. Google's been great. We're up 108% on them. So yeah, this is the portfolio that's really underperformed. But look at us year to date, we're down 1.6%. From 1 year ago exactly, we're only up 1.8%. So this has been my worst performing portfolio, but it's actually been my Mumu portfolio that's led us to still outperform the S&P 500 when I weight all my portfolios together. Year to date, since January 1st, return money weighted, we're actually up 50% just since January 1st, mainly led by Comfort Systems, Powell, Amphenol. These have been doing great. Actually, Coca-Cola Consolidated's done really good. Wow, I'm up 70% on them now. Actually, right when the stream ends, I actually might go buy 1 more share of Amazon. I don't mind buying more shares of a stock, even though I'm up on them, if they're a quality, undervalued stock, because I just want to up my quantity of shares. I could be up 1,000% on a stock and own 10 shares of it, but the person who owns 11 shares and was up 10% is still beating me. So anyway, hope you guys have a great rest of your day. If you want to help me out, subscribe to my YouTube, type into YouTube Nathan Robert. That's the only way to support me and mean more than a donation. Oh, and if you want to, anyway, have a great day. See you later. If you want to get this app I'm on, it's a brokerage. It's linked in bio there. I saw someone ask that. And thanks again to everyone on YouTube. Oh, I meant to get to APLD. I'm sorry, Bull. Dang, I've been live for over 2 hours. I got to go, but thanks for showing up, man. Thanks for